Committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Oversight of the Prudential Regulators, and without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. Just a few scheduling items to mention at the top. This hearing has a hard stop at 1 p.m. Out of a pre-negotiated agreement. The committee photograph will be taken immediately thereafter. So if you can come back, you want to participate in the photo, it's a nice moment of bipartisanship. It's also another opportunity for my Republican colleagues that are seeking the gavel next Congress to make sure that I leave. So I expect their attendance will be pretty high. I encourage members to respect the 5-minute rule so we can get through questions this morning in an ample way. There's still work to be done for our oversight. Finally, this is potentially the penultimate hearing for this committee. We'll see what the schedule looks like for the next month and a half, but we'll continue to have those conversations. I'll now recognize myself for 4 minutes for an opening statement. The era of post-financial crisis regulation is over. For the past decade, your agencies have worked to push credit risk out of the banking system. At the same time, you completely missed the interest rate risk on bank balance sheets in March of last year. This led to 3 of the largest bank failures in American history that occurred last year. Time and again, your agencies have also worked to stifle the beneficial role that innovation and technology play in our financial system. It's clear our banking regulators under Democratic leadership have been busy fighting the last war. It's clear our banking regulators under Democrat leadership are working in a different way than Hill Democrats are about these subject matters. Your backward-looking approach to regulation has harmed our financial system, innovation, and consumers. In contrast, the House overwhelmingly voted to reject your approach and embrace an inevitable technology-based future by passing things like FIT 21 to give market regulation to digital assets, which represents the largest rewrite of financial regulation since the passage of Dodd-Frank, and a large bipartisan vote with 2/3 of the House supporting that measure, with 71 Democratic members supporting that legislation in particular. I repeat, the most extensive rewrite of financial regulation since Dodd-Frank passed with overwhelming bipartisan support. That would have been an encouragement for agencies to think differently. We need new technology-based solutions that strengthen our financial system, help consumers, and make our regulators more efficient. Instead of working with Congress to identify these solutions, your agencies have proposed a new regulatory onslaught amounting to a sweeping rewrite of the rules governing U.S. financial institutions. And again, I say that you're working in a different way than my colleagues here in the House and the Senate are trying to operate in a bipartisan way. These proposals frequently included inadequate economic analysis, weak justification, and limited public engagement. Your power grabs not only harm consumers in our financial system, but they also erode the credibility of your historically independent agencies. And that independence is important. First, the Biden administration's politicized partisan regulatory agenda has practically destroyed your agency's credibility with Congress. By skirting congressional oversight and ignoring the will of the people's representatives, you have eroded the trust in your agency's abilities to act independent of politics. Second, your overreaching and rulemaking diminished your credibility with the courts. This is what you've presided over. Even after the Supreme Court's decision in West Virginia versus the EPA, this administration's regulators are pushing new rules with paltry and sometimes non-existent statutory justifications. Third, the American people have lost trust in our regulators' ability to act in their best interest. This administration's regulators have repeatedly advanced rules that reduce access and increase costs of the financial products used by everyday Americans. Because of your actions, the political independence and authority of your agencies is in danger of being reduced, whether it's by Congress, the President, or the courts. I'm sure my colleagues across the aisle may disagree on certain matters here, so I'll run through a set of facts here. The OCC has been led by an acting head for all 4 years of the Biden administration. Yet, Mr. Hsu, you have gone along with every politicized initiative put forward, and yet the president never put you forward for a nomination, even though you have enormous credibility, though I disagree with your approach and how you've gone along with the other regulators, and you've not shown independence, but you could have gotten confirmed by a Democratic Senate. Vice Chair Barr, your headline proposal, the Basel III endgame, was rejected by your colleagues and the public. Meanwhile, all 3 banks that failed last year were under Fed supervision, and you are the vice chair for supervision. Chair Gruenberg, you are in a league of your own. You failed in your leadership of the FDIC, and that will result in a total overhaul of your agency in coming years, so no one who sits in your seat can take the type of actions that you've taken and the abuse that you've rendered to your employees. Resigning in January is too little, too late. That's why Republicans introduced a resolution calling for your immediate termination. Chairman Harper, thank you for being here.
You're welcome.
And as I said at the top, the era of post-financial crisis regulation is over. The evidence is clear. This administration's regulators failed to see it, and unfortunately for you all, it's too late to right this ship. Look forward to the next ship. I yield back, and I'll now recognize the ranking member for 5 minutes.
Thank you very much, Mr. Chairman. Vice Chair Barr, Chair Gruenberg, Chair Harper, and Acting Comptroller Hsu, I want to thank each of you and all of your hard-working government employees for the great work you've done to strengthen our nation's financial system coming out of the pandemic. It is much more difficult to build something strong, as each of you have done, than it is to basically tear something down. I'm concerned about what the next 4 years will bring. Trump promised the American people that he would bring down inflation and strengthen the economy. But Matt Gaetz, a man investigated by the Department of Justice for sex trafficking and the subject of a lawsuit, not to mention a supposedly scathing ethics committee report, is Trump's nominee to lead the Justice Department. While my Republican colleagues have demanded that the FDIC chair resign and released a report late last night about the cultural problems at the agency, they have been eerily silent about Matt Gaetz' candidacy. To be clear, Matt Gaetz is accused of having sex with a 17-year-old girl, taking this 17-year-old girl across state lines for sex, and paying this 17-year-old girl for sex. All of these are crimes. But where are the calls for his nomination to be withdrawn? Let me just say that Chair Gruenberg indicated that he's leaving, but no, that's not enough for you. You said immediately. What do you want him to do? Get up out of his seat now and walk out of the door? No one on this committee should be okay with a sex trafficker running the Department of Justice, but I'm not just concerned about the Department of Justice. I'm concerned about our nation's consumers under a new Trump administration. Elon Musk, the co-president, the richest person on planet Earth, has pushed his way into a highly influential government role and now stands to personally make billions more from his access to the levers of government, while he guts the government's tools that protect working class Americans. But I guess if you're rich and you're co-president, you can get away with it. We know what the future holds. Trump and his appointees will seek to gut guardrails that keep Wall Street, mega banks, and crypto in check. They will rubber stamp bank mergers to allow big banks to get even bigger and give a free pass for banks to charge billions of dollars in new junk fees. And in a Trump administration where there will be no one to hold these big banks accountable, as Project 2025 promises to eliminate the only watchdog that focuses solely on our nation's consumers in the financial marketplace. The Consumer Financial Protection Bureau, working families have said that the cost of living is too expensive and affordable housing is out of reach. But we know that critical housing programs will be cut and housing costs will skyrocket. Small businesses that barely survived the pandemic will be crushed by Trump's new taxes, while major corporations will pass the increased cost of goods onto the American people. And after the military is deployed to deport millions, prices will climb even higher without workers in agriculture, construction, and other industries that rely on immigrant labor. Implementation of Trump's policies will bring back inflation. At the same time, he is trying to abolish the one government agency charged with protecting against inflation, the Federal Reserve. This is not what the American people voted for. But I guess Trump and his co-president, Elon Musk, are all poised to do all of the things, basically, that Trump has promised. I yield back.
I look forward to the next Congress, watching from the cheap seats. I'll now recognize the chairman of the Subcommittee on Financial Institutions, Mr. Barr, for 1 minute.
Thank you. This year, I led a bipartisan congressional delegation to Basel, Switzerland, to meet with the Basel Committee on Banking Supervision Secretariat General and other BCBS leadership to discuss the United States implementation of the Basel III Endgame. There, I made a point that there is some utility to cross-border harmonization and regulatory convergence to protect the stability of the global economy. However, that should not be the ultimate goal in implementing Basel III Endgame. The goal needs to be economic growth. And the BCBS officials acknowledge that the Vice Chair's original proposal is inconsistent with the capital neutrality of the Basel Agreement and gold plates American capital requirements. Gold plating our requirements will not stimulate but stagnate growth by causing less availability and higher cost of credit. The American people sent a message in November. They want their economic prospects lifted. They want economic growth. We must listen to our fellow Americans and implement capital requirements that better the economy. I yield.
We'll now recognize the ranking member of the Subcommittee on Financial Institutions, Dr. Foster, for 1 minute.
Thank you, Mr. Chairman, and to our prudential regulators for joining us today. First, I want to commend you for everything that you've done, strengthening our banking system, protecting consumers, and responding to rapidly changing financial conditions. Your agencies, along with the CFPB, have left our financial system and our economy the envy of the world. From the Biden manufacturing boom to the record stock market valuations to the record low unemployment, we are passing to the next administration the greatest economy the world has ever seen, and don't ever let anyone tell you differently. During the campaign, we were told not to worry that Project 2025, with its massive tariffs and threats to Fed independence, wouldn't really represent the agenda of the incoming administration. But looking at Trump's appointments, we see that these dangerous proposals must be taken seriously. They include limiting the Federal Reserve's role as a lender of last resort, really, and the elimination of the CFPB and threats to career civil servants who have long provided critical nonpartisan expertise to our regulatory bodies. My colleagues across the aisle owe it to the American people to quickly make it clear which of these threats we should take seriously so we can have a robust public debate about the real-life consequences that will ensue. Thank you, and I yield back.
Gentleman yields back. If I may take a point of personal privilege, when you announce that you're retiring, your staff starts looking for work elsewhere. And so I've made a point during my service in my 20 years in Congress to have a deep level of appreciation for the staff of this place. It is truly the staff of this institution that makes it work. When members can't talk to each other, their key staffers must be able to talk to each other. And on this committee, they always have. And at times when they were not talking, we were still talking. So it's nice to have that, and a trusted group of people that you can rely upon for guidance when you're doing well, but most especially when things are a challenge. And so I want to thank the staff of this committee on the Democratic side and on the Republican side for their long-term work for this institution, for their service to our government, and as citizens to make this place better and to make it work. And the reason why I bring this up today is because my communications director, Laura Peavy, who's been with me for 6 years as ranking member and now as chair, is leaving. This is our last week on the Hill. And Laura, I want to say thank you to you. I've trusted you with my words, both written and spoken. I've sometimes listened. I've sometimes, but often, mispronounced things that you've written, and you've made me sound better than I otherwise would. And the things that I said that did not make sense or had some syntax problem, that was all me, not Laura. But she's been a thoughtful messenger, strategy, developer of strategy, and a trusted counselor for me. Whether it's COVID, CARES, GameStop, the collapse of FTX, the bank failures, the debt ceiling negotiations, that weird time where I was Speaker Pro Tem. It was an odd time. She's always been a steady hand, even-keeled, thoughtful, always had her head about her, and one of my most trusted advisors. And even when reporters were hounding her when I was Speaker Pro Tem, she was still able to get married during that time. So I want to thank you, Laura, and actually David for his forbearance and surviving through that time. The pictures are beautiful of your wedding day, and I'm sorry it was in the midst of all this chaos. But thank you, Laura, for your service, your counsel, and your friendship, and wish you well. Yes, and she is beet red. So with that, thank you for your forbearance there. We'll now recognize the testimony today of the Honorable Michael Barr, Vice Chair of Supervision for the Board of Governors of the Federal Reserve System, the Honorable Martin Gruenberg, Chairman of the Federal Deposit Insurance Corporation, the Honorable Todd Harper, Chairman of the National Credit Union Administration, and Mr. Michael Sue, Acting Comptroller of the Currency. We'll now just go right down in that order. Mr. Barr, you're now recognized for 5 minutes.
Thank you, Mr. Chair. Before I begin my formal remarks, let me just say how much I appreciated your comments about the staff of this committee, who I've worked with for many, many decades at this point, and I'm just as grateful as you are for their professionalism and support. Mr. Chairman, Ranking Member Waters, and other members of the committee, thank you for the opportunity to testify in the Federal Reserve supervisory and regulatory activities. Accompanying my testimony is the Federal Reserve Semi-Annual Supervision and Regulation Report. Today, I will discuss current conditions in the banking sector and our recent supervisory and regulatory activities. Overall, the banking system remains sound and resilient. Banks continue to report capital and liquidity ratios above minimum regulatory levels, and asset quality generally remains sound. Bank lending has continued to grow, albeit at a modest pace, that reflects decreased demand and tighter lending standards than we have seen since early last year. Capital ratios have increased this year, building on the capital increases from the year before and leaving the system better positioned to weather potential losses. This is supported by this year's stress test results, which show that large banks have sufficient capital to meet their minimum capital ratios and can continue their operations under a highly stressful scenario. Liquidity conditions overall are stable. Notably, deposits and liquid assets on bank balance sheets remained steady in the first half of the year. Additionally, the share of uninsured deposits in the system continued to decline, falling to a level last seen in 2019. While the system as a whole is resilient, we are carefully monitoring the continued rise in delinquency rates among certain commercial real estate loans, such as those backed by offices, especially in major cities, and more recently, those backed by certain multifamily housing units. Delinquency rates for certain consumer loans are also elevated. In response to rising delinquencies, banks have increased loan loss provisions. Cybersecurity risk also continues to be a supervisory priority. The Federal Reserve's supervisory activities in this area promote financial institutions' ability to protect against cyber incidents, safeguard critical infrastructure, and address emerging technology risks. Federal Reserve supervisors continue to work diligently to assess all bank risk management practices to be prepared for both expected and unexpected losses. We continue to make progress on improving the speed, force, and agility of supervision to better align with risk, size, and complexity of supervised banks as appropriate. This is necessary to ensure that banks and supervisors are managing the types of risks highlighted by last year's stress in the banking system. Supervisors must be prepared to take timely action as risks build up, deploy supervisory tools and escalation effectively, account for changes in market, economic, and financial conditions in their examination priorities and supervisory conclusions, and identify new and different patterns of risk. We have made progress on these goals. First, we are working to ensure that supervision intensifies at the right pace as a bank grows in size and complexity. Second, we are modifying supervisory processes so that once issues are identified, they are addressed more quickly by both banks and supervisors. Third, we are finding ways to better incorporate forward-looking risk analysis into supervision. Moving to regulation. As you know, last summer, the board sought comment on 2 proposed rules that would modify risk-based capital requirements for large banks: the Basel III Endgame proposal and the proposal to adjust the capital surcharge for the largest and most complex banks. We asked for and received a great number of comments on all aspects of the proposals. And earlier this year, I laid out potential adjustments to these proposals based on those comments. Last year, the bank regulatory agencies also invited comment on a proposal to require large banks to issue and maintain a minimum amount of long-term debt. We received feedback from commenters on potential adjustments to the proposal, which are under consideration. And as I have mentioned in previous speeches, we have been considering ways to improve liquidity resilience and improve banks' ability to respond to funding shocks. These initiatives have been joint efforts among the Federal Reserve, FDIC, and OCC, and we look forward to that continued collaboration next year. We will continue to seek an approach that helps to ensure financial system resilience and supports the flow of credit to households and businesses through the economic cycle. Thank you. I'm happy to take your questions.
We'll now go to Mr. Gruenberg.
Thank you, Mr. Chairman. If I might echo Vice Chairman Barr, as a former congressional staffer in both the House and the Senate, I have a pretty deep appreciation of the contributions staff make and would want to acknowledge the professionalism of the staff on both sides of the aisle of this committee, if I might. Chairman McHenry, Ranking Member Waters, and members of the committee, I'm pleased to appear at today's hearing on the oversight of prudential regulators. The banking industry continued to show resilience in 2024 following the failures of 3 large regional banks in the spring of last year. Net income remains relatively high, and asset quality metrics remain generally favorable. The industry's overall non-current rate remained unchanged from the second to the first quarter of this year at a level well below the pre-pandemic average non-current rates. That being said, the industry continues to report weakness in several loan portfolios, including commercial real estate and credit cards, as well as deterioration in multifamily loans. The industry's non-current CRE and multifamily ratios increased from the first to the second quarter of this year, and the credit card non-current rate remained elevated. Non-current loan balances continued to increase in the industry's non-owner occupied CRE loan portfolio, largely driven by commercial office loans. And primarily due to credit card losses, the industry's net charge-off rate remained elevated in the second quarter. In addition, the second quarter of 2024 marked the 10th straight quarter that the banking industry reported unusually high unrealized losses on available for sale and held-to-maturity securities since the Federal Reserve began to raise rates in the first quarter of 2022. These are all matters of close supervisory attention. The FDIC's deposit insurance fund balance as of June 30th of this year totaled $129 billion. That's up $7.5 billion from December 31 of last year. And the DIF remains on track to meet its statutory minimum reserve ratio by the legal deadline of June 30th, 2028. The bankruptcy of the non-bank company Synapse has underscored concerns associated with some bank arrangements with third parties to deliver bank deposit products and services. As a result of the inadequate records maintained by Synapse, its non-bank partners, as well as the banks involved, the banks encountered significant difficulties in returning money deposited through Synapse to the consumers and businesses who were beneficial owners of funds deposited by Synapse in the banks. To prevent similar problems, the FDIC board has proposed a new rule that would strengthen FDIC-insured depository institutions' record-keeping of consumers and business funds in certain custodial deposit accounts opened by third parties. Once in place, these new requirements would ensure that these deposit account records are accurate, complete, and timely. While the banking agencies are unlikely to complete their work on the Basel III proposal in the near future, I look forward to the agencies working together to bring Basel III to a conclusion that will strengthen bank capital and bolster financial system resilience and stability in light of our experience during the 2008 global financial crisis, while being responsive to commenters' concerns relating to credit, operational, and market risk. Similarly, it is important for the banking agencies to finalize the proposed rule on long-term debt for large regional banks to mitigate the run risks of concentrations of uninsured deposits that we experienced in the failures of 3 large regional banks last year. Finally, I want to report on efforts to address the workplace culture issues at the FDIC. This summer, the FDIC board appointed an outside independent transformation monitor to audit our efforts and an outside expert to assist the FDIC in achieving its goals. This fall, the board appointed 2 highly qualified experts from outside the agency to head 2 new independent offices that will have responsibility for receiving, investigating, and acting on all allegations of misconduct. A detailed appendix describing our progress is attached to my testimony. Thank you again for the opportunity to testify today. I'll be glad to respond to your questions.
Mr. Harper.
Chairman McHenry, Ranking Member Waters, and members of the committee, thank you for the invitation to discuss the NCUA's recent work. And Mr. Chairman, thank you for excusing me from the last hearing as I underwent double cervical disc replacement surgery. I also fully agree with your remarks, having worked for this committee for 12 years, the importance of maintaining bipartisanship and conversations across the aisle. It's something that I've tried to model as the NCUA chairman as well as a board member. Overall, the credit union system remains strong, as demonstrated by its robust aggregate net worth ratio. The agency, however, has identified growing signs of weak loan performance, elevated delinquency rates for credit cards and auto loans, especially used auto loans, and lower earnings across the system. Moreover, nearly 1 in 5 federally insured credit unions currently is a Camel's Code 3, 4, or 5 institution. That includes 9 troubled complex credit unions with $500 million or more in assets. Together, these complex credit unions with composite Camel's Code 4 and 5 ratings hold nearly $14 billion in assets. To maintain the strength of the system, the NCUA will continue to work closely with these institutions to mitigate problems before they cause losses to the Share Insurance Fund. Another essential part of the NCUA's statutory responsibilities is examining credit unions with less than $10 billion in assets for compliance with consumer financial protection laws and regulations. In 2024, the agency has focused on overdraft programs, fair lending, automobile lending, and Flood Disaster Protection Act compliance. Beginning with the 2024 First Call Report, the NCUA also required federally insured credit unions with more than $1 billion in assets to separately disclose their income from overdraft and non-sufficient fund fees. In addition to promoting transparency and greater uniformity with banks, which have reported such fees since 2015, these changes allowed credit unions to benchmark their overdraft programs against their peers. The NCUA also continues to support the efforts of credit unions that are minority depository institutions through grants, training, annual symposiums, and customized exams and support. MDIs offer access to safe, fair, and affordable financial products and services to historically under-resourced communities. At the end of the second quarter of 2024, we had identified 490 MDI credit unions. That's more than 1 in 10 federally insured credit unions. Collectively, these MDIs serve millions of members and held more than $90 billion in assets. Additionally, MDI credit unions tend to be smaller institutions, yet their aggregate financial performance measures, including return on average assets, net worth ratios, and net interest margins, are comparable to and often exceed those of larger credit unions. The future success of MDI credit unions is integral to ensuring that the system lives up to its statutory mission of meeting the credit and savings needs of members, especially those of modest means. In our written testimony, the NCUA has outlined several changes to the Federal Credit Union Act to better enable the agency to protect the system of cooperative credit. Let me focus on one of those issues here. Cybersecurity threats within the financial services industry remain high and highlight the credit union industry's vulnerability to cyber attacks that can debilitate our nation's critical infrastructure if left unchecked. 1 year after the NCUA's cybersecurity incident rule took effect, the agency has received more than 1,000 reportable cyber incidents. 7 out of 10 of those cyber incidents related to credit union vendors. What's more, credit unions holding approximately 90% of industry assets use key services offered by unregulated third-party service providers, posing potential risks to financial stability. Last November, for example, a single third-party vendor cybersecurity incident disrupted the daily operations of 60 credit unions. This lack of visibility impacts the credit union's safety and soundness and exposes the Share Insurance Fund to potential losses. Again, the NCUA requests that Congress restore the NCUA's supervisory authority over third-party vendors. In sum, the NCUA will continue to oversee credit union performance and coordinate with other financial institution regulators as appropriate to ensure the overall resiliency of our nation's financial services system and the broader economy. Going forward, Congress can enhance these efforts by adopting the legislative changes we've recommended. Thank you. I look forward to your questions.
Mr. Sue.
Chairman McHenry, Ranking Member Waters, members of the committee. I'm pleased to appear today to discuss the activities of the OCC. My written testimony provides an update on the condition of the banking system and other matters. I would like to use this time to reflect on the last 3.5 years. Banking rests on trust. Trust enables growth and opportunity for individuals and communities and allows the economic pie to grow. Bank regulators serve as guardians of that trust. When I became acting comptroller in 2021, I identified 4 priorities for the OCC, each anchored in fostering trust in banking. The first priority was guarding against complacency. In 2021, the economic outlook was surprisingly positive given the COVID pandemic. Coordinated actions by the government and banks had been effective in preventing economic collapse. Credit performance was historically strong, businesses were growing, and innovation was taking off, especially in crypto and amongst fintechs. Those conditions felt familiar and ripe for complacency. In response, I prioritized risk management and encouraged bankers and supervisors to be vigilant. That proved prudent. In the following years, crypto lost over $2 trillion in value, and many platforms failed. Inflation and interest rates rose rapidly, stressing parts of the banking system, and commercial real estate concerns grabbed market headlines. Throughout this period, OCC-supervised banks stood strong. Customers and counterparties to national banks and federal savings associations were able to have peace of mind, despite the volatility and uncertainty. That was not luck. It was due in part to our persistent emphasis on strong risk management and guarding against complacency. The second priority was elevating fairness. Since 2021, the OCC has strengthened and modernized the CRA, reformed overdraft practices, updated our fair lending screens and examinations, and expanded financial inclusion through Project Reach. This past year, we increased our focus on consumer financial health, in particular on its measurement. Building on the idea that what gets measured gets managed, the OCC published a report in June that defined financial health and identified 3 potential vital signs metrics that can be used to gauge the financial health of individuals in real time. Our work with consumer advocates, research organizations, and banks will further develop and test these ideas. The third priority was adapting to digitalization. Banking services are no longer provided by just banks. The digitalization of banking has allowed non-bank fintechs and big techs to offer payment, lending, and deposit-taking services to their users. While this evolution has fostered greater competition and innovation in digital banking, it has also confused consumers, diffused accountability, and created an unlevel playing field. Since 2021, the OCC has been highlighting these challenges and working to address them. Last year, the federal banking agencies issued interagency guidance on third-party risk management. This past July, we issued a focused RFI on bank fintech arrangements and effective risk management practices. We're currently considering the feedback received. I am a strong supporter of responsible innovation, guided by the maxim, the better a car's brakes, the faster you can drive it safely. In February, the OCC hosted a symposium on the tokenization of real-world assets and liabilities. It focused on how to build the proper legal and risk management foundations for faster, cheaper, and lower risk settlement. The fourth priority was managing climate-related financial risks. The OCC has taken a deliberative, safety and soundness-focused, common-sense approach to climate-related financial risks, focusing on large banks with over $100 billion in assets. In addition to these priorities, fostering trust requires balanced and active outreach to all stakeholders. I've prioritized meeting with community banks, hosting regular gatherings with community advocates and civil rights groups, engaged academics, and visited local communities across the country from Midland, Texas to Polson, Montana. Directly engaging a wide range of stakeholders, meeting them in their communities and actively listening has helped keep me and the agency grounded in what we do and how we approach issues. Most importantly, it's helped to foster trust. Finally, I too want to recognize the staff for the OCC, who are true unsung heroes. Their work is invisible to most Americans, yet their impact is huge. I'm proud to have been part of this agency and to have joined such dedicated public servants in a mission focused on ensuring the safety, soundness, and fairness of the federal banking system. I know OCC employees will remain committed to the agency's mission in ensuring that the federal banking system remains a source of strength to the U.S. economy. Thank you.
Thank you for testimony. I'll now recognize myself for 5 minutes. Vice Chair Barr, yesterday the law firm of Latham & Watkins released an analysis of your September 10th Brookings speech outlining your proposed changes to the Basel III Endgame proposal. The analysis suggested that, quote, of the 75 material substantive issues raised by the public comments, 24% were addressed by the Barr speech. By contrast, 76% of the material substantive issues were not addressed. I assume you saw this in your prep for this hearing. You commented previously that any change to the Basel III Endgame proposal would be, quote, broad-based and material. Do you believe that your changes to the proposal will impact less than a quarter of the issues, or are they broad-based and material?
Thank you, Mr. Chair. The changes we proposed in that set of remarks and that were conducted in collaboration with the FDIC and OCC are broad-based and material. They take on the major issues in the comment letters that have the most material impact. They're not designed to be comprehensive. There are additional changes that I would expect would be appropriate prior to finalizing the Basel III Endgame rule, but they address the most material comments that we got across the full range of suggestions from commenters.
Sure. Would you identify the individuals and groups with whom you've consulted and how they went about revising the current proposal? And how you went about revising the current proposal?
I'm sorry, it's hard to see you from where I'm sitting. So,
but you can hear me, and that's the
I can hear you.
important
Okay.
thing. You don't have to look at me. There's a whole panel here. It's fine.
The comments that we got back from the public were really quite broad-based. We took in all those comments, and so I reached out across the public comments that we got from across the financial sector, from academics, from other members of the public, from my colleagues at the OCC and the FDIC, and my colleagues on the Federal Reserve Board.
Chair Gruenberg, since May, the committee has requested your presence to discuss the FDIC toxic workplace. We've attempted to accommodate your requests, yet you've failed to appear even behind closed doors. You failed to appear behind closed doors for a transcribed interview. Has the FDIC approved your indemnification request?
Mr. Chairman, I haven't made any indemnification.
Oh, you haven't? Okay. Will you appear on December 9th as you previously agreed?
I believe we have engaged on that, and that was the date we've identified.
That is not an answer to my question.
No, that's my intention, Mr. Chairman.
It is your intention to appear on December 9th?
Yes.
Have you hired personal counsel, or will you be represented by agency counsel?
I believe agency counsel, Mr. Chairman.
So why did it take more than a month for you to figure out your representation?
I think the legal division was trying to sort out that issue and came to the conclusion that agency counsel would be appropriate.
Okay, but it took a month to do that.
That's my understanding.
Okay. So our first request was in May, and you've stonewalled us because it's an election year and you were hoping to get through. But I noticed you've said that you're going to quit the day before the incoming president's likely to fire you. And we're supposed to have this as a welcome set of news. I welcome it, but you should not be heading the agency. How many rulemakings have you proposed or finalized since you announced your resignation in May?
I'd have to go back and check the record. Specifically, I'd have to go back and check to be sure, Mr. Chairman.
So with all these changes in the administration coming, the expectation from Congress is that all of you will adhere to the Federal Records Act. And so I'd ask the whole panel here, will you commit to abide by the Federal Records Act and preserve all your records and documents to assist and support the incoming administration? Mr. Barr?
We always do, and we will.
Yes.
We always do as well, yes.
Yes.
Okay, thank you. And with that, I'll now recognize the ranking member for 5 minutes.
Thank you so much. Vice Chair Barr, given the circumstances, I feel compelled to ask you the same question I asked Chair Powell in July 2019 when he was sitting in the same chair as you are. That is, I asked the Fed chair if Trump or his co-president called and said, "You're fired, pack up, it's time to go," what he would do. Chair Powell's response to this question was, quote, "My answer would be, no, the law clearly gives me a 4-year term, and I fully intend to serve it." Chair Powell recently reaffirmed this. So, how about you? Vice Chair Barr, would you pack up and go if Trump or Elon Musk called to fire you?
Congresswoman, as Chair Powell said, we serve fixed terms of office, and I intend to serve my fixed term of office.
Thank you. The independence of our agency, like the Federal Reserve, has been critical to supporting the stability of our economy for more than a century. So I hope my colleagues on both sides of the aisle will join me in supporting you and Chair Powell to defend that independence. The Fed has a responsibility known as the, quote, dual mandate. This is for you, Vice Chair Barr, to promote stable prices and full employment. The Fed has spent the last couple of years doing just that and helping protect the United States from global inflationary period and bringing inflation back to your target of 2%. However, experts have warned policies of the new administration are expected to cause inflation to skyrocket. Setting aside the merits of different policy choices, it is important for Congress to understand the economics different options may cause. To that end, would deporting millions of people and imposing across-the-board taxes on imported goods through tariffs likely to have an inflationary outcome?
Congresswoman, as you pointed, I think we've made enormous progress on our dual mandate. Inflation has come down dramatically from its highs 2 years ago. The unemployment rate remains at historically low levels. We've seen significant growth in the economy and a real significant boost in productivity, which are all positive for the American people. In an economy as big and diverse and broad and dynamic as ours, it's very hard to say what any particular policy input will be without knowing more about it. It's early for us in that kind of assessment. As we learn more about what the policies of the new administration might be, those will begin to be introduced into scenarios and forecasts and other measures of the economy.
Thank you, Chair Powell. I'm sorry, Chair Powell, I want to say earlier this year, he said that the United States is on an unsustainable fiscal path. In 2017, we were told that Trump's tax cuts for corporations and billionaires like Elon Musk would pay for themselves, but that, of course, did not happen. The Nonpartisan Congressional Budget Office estimated that if Congress extends these tax cuts, it would add $4.6 trillion over the next decade to our deficit. Would that make our fiscal path even more unsustainable?
Congresswoman, fiscal policy is obviously the purview of the Congress and the President, not of the Federal Reserve. We take fiscal policy as a given input into our approach. I agree that in the very long-term sense, I agree with Chair Powell that the path of fiscal policy that we are on and have been on is not sustainable, but we don't get involved at all in fiscal policy decisions of any administration or of the Congress.
Do you have an opinion about what would happen if millions of individuals would be deported? And what would that do to businesses in this country? Would that cause inflation?
Congresswoman, it's early, as I said, in our thinking, trying to understand what the policies of the new administration might be. Really, in an economy as diverse and big and complex as ours, policy is one input into that, but we look at the whole picture, and as we learn more, that will begin to be incorporated into our thinking, into our forecasts, into alternative scenarios about the economy.
Thank you very much. I yield back.
Gentlelady yields back. We'll now recognize the Vice Chair of the full committee, the gentleman from Arkansas, Mr. Hill.
Thank you, Mr. Chairman. Let me also thank you and the ranking member for your work together in leading the committee in this Congress. We're all grateful for your leadership and that of the constructive relationship you have with the ranking member. Chairman Gruenberg, you told the chairman that you'd announced your intention to resign some 6 months ago, principally because of a failed culture at the FDIC of sexual harassment, misconduct, and retaliation at the agency. So why are you waiting another 2 months to step down? You have a fiduciary responsibility to good governance at the FDIC that, in my judgment, supersedes your political responsibility. And here, with a clear win by President Trump and the executive branch changing hands in January, makes even more sense that you resign before that time. Why are you waiting?
Congressman, I indicated previously that I would step down when there would be a confirmation of a successor.
But that was an impractical suggestion because that wasn't going to happen in an election year, and Mr. Schumer can't magically make that happen. And who was nominated to take your place? So let's get to the facts. Why do you wait? Why don't you make December 9th, if you're going to appear before this committee, why don't you make that your resignation date?
Well, as I indicated, I indicated I would step down when a successor was confirmed. It's now pretty clear that's not likely to happen. So I thought it was appropriate for me to step down at the end of the president's term.
I don't think that's acceptable, and I think on both sides of the aisle, everybody is disappointed with what's happened at the FDIC under your leadership, and I think you would have served the president, this current president, President Biden, much better by resigning sooner. And you're now overseeing, putting forward regulatory ideas in an administration, again, that's changing, and I don't support those. I appreciate the chairman going down that list. That's why I sent each of you a letter last week calling on you to halt all rulemaking actions to suspend and promulgation of any new rules, regulations, including guidance. Agencies should suspend compliance dates even for certain rules. And I think you're going to hear from, I think you've already heard from soon-to-be chairman of the Senate Banking Committee, Tim Scott as well. Without objection, Mr. Chairman, I'd like to insert that letter in the record.
Without objection.
One such regulation at the FDIC is the broker deposits proposal, which you will be receiving a letter from committee Republicans shortly. In our view, it's inappropriate for a resigning chairman like you to attempt to force through a controversial rulemaking before you leave, especially one that doesn't have the support of the full FDIC Board of Directors. As a matter of fact, the Biden-Harris administration should abandon plans to proceed not only on this broker deposit rule that you're considering, but all the current pending rulemakings, including Vice Chair Barr, the Basel III endgame, the proposed amendments to changing bank control regulations, the CFPB larger participants rulemaking, the PCABOB's no clear proposal, and the SEC's Reg ATS. The people of the country have elected President Trump. They want change. We're going to have change in the independent agencies and the executive branch, and so we don't want to spend the last few weeks of the Biden administration fighting over bad policy ideas. Under the Obama and Biden administration, we instead saw the government was weaponized, and this committee on both sides of the aisle have talked about Operation Choke Point. We talked about people's individual rights on firearms and firearm-related businesses in your previous tour with the Obama administration, and in this administration, we've had conversation after conversation about digital assets being debanked by the Biden-Harris administration. So much so that even Ranking Member Waters said the following: on Operation Choke Point, I don't believe an American citizen should have their bank accounts closed down and nobody tells them why, or you have nowhere to appeal. So I know we can work with Republicans on something like that. And I agree, no one thinks this is fair. And I hope, Madam Ranking Member, we can work on that. Mr. Gruenberg, do you agree with what Ranking Member Waters' statement?
I certainly, well, the short answer is yes, and I would say for any time an account is closed, we have a policy at the FDIC of notifying the institution and providing an explanation in writing as to why that's occurred, as well as the legal basis for the action.
Do you have any evidence that the FDIC examiners have attempted to use verbal direction to banks about digital asset debanking to avoid the Freedom of Information Act?
Congressman, not that I'm aware of.
Yield back, Mr. Chairman.
Gentleman yields back. We'll now recognize the gentlewoman from New York, Dr. Velasquez, for 5 minutes.
Thank you, Mr. Chairman. Chair Gruenberg, last year the FDIC closed a deal with Community Preservation Corporation for CPC to service Signature Bank's rent-stabilized loan portfolio. Under the deal, CPC acquired a 5% equity stake in two entities, while the FDIC retained a 95% stake. Combined, the two new entities contain 868 loans valued at approximately $5.8 billion and are secured by 35,000 rent-stabilized multifamily units, many of which are in my district. How is the FDIC continuing to work with the CPC to ensure proper servicing and performance of these loans, while also ensuring these units remain rent-stabilized as the FDIC is required to do under the statute?
Congresswoman, that's a very significant responsibility that the FDIC inherited as a result of the failure of Signature Bank. We worked closely with the city and state officials as well as local community organizations in dealing with the large portfolio of multifamily housing that we inherited. In particular, we identified the multifamily properties that were perhaps at most risk and engaged, as you suggest, with the Community Preservation Corporation for the management of those properties. We reached an agreement with them. We retain a substantial interest. We monitor the management of those properties on a regular basis, and we have a long-term stake in ensuring that those properties are maintained for the people, for the residents who live in them.
Thank you. And Chair Gruenberg, last week, CFPB Director Chopra submitted a statement as part of the FDIC's Board of Directors meeting asserting that the status quo on deposit insurance was fundamentally unfair for borrowers at smaller banks. He states how big businesses that are able to put their money in big banks enjoy free deposit insurance, while smaller businesses that deposit their money in small banks don't. He references a recent incident in rural Oklahoma where some depositors were forced to take losses after their small community bank failed due to fraudulent misconduct, as an example. Do you agree with Director Chopra's statement? Do you think the limits and structure of deposit insurance is unfair for depositors at smaller institutions?
I think there are changes that can be made that would be helpful in that regard. As you may know, the FDIC did a report last year on options for deposit insurance reform. The option we thought that was most viable, and that I believe Director Chopra identified in his statement, was to look at business payment accounts, which are highly valued both by banks and by small businesses operationally to allow for the payment of employees.
Well, let me just say that I agree a lot with Director Chopra. As a member of this committee and both chair and ranking member on the Small Business Committee, I have seen how big, well-connected businesses can easily deposit their money into the large and well-connected banks. And when these banks get into trouble or fail, insured and uninsured depositors are often protected. But for the small businesses in the rural and underserved parts of our country who deposited their money with small banks like First National Bank of Lindsay, they are left behind because the failure of their bank wouldn't be characterized as having a systemic impact. The current system gives an unfair and competitive advantage to the largest banks in the country and the depositors who deposit with them. Of all the things a small business should have to worry about, the failure of their bank should be one of them. And I hope this is an issue that this committee can tackle in the future. Vice Chair Barr, in September you announced that there will be a proposal of the Basel III Endgame rule. At a recent post-FOMC press conference, Chair Powell indicated that there could be a conclusion to this rulemaking sometime in the first half of next year. Do you think this is a realistic time frame? Do you think we will see a final rule by the time?
Congressman, I'm committed to working to finalize the Basel III capital rule. I'm looking forward to working with my new colleagues at the OCC and the FDIC to do that in the coming year.
Thank you. I yield back.
The lady is back. We'll now recognize the gentleman from Iowa, Mr. Nunn, for 5 minutes.
Thank you, Mr. Chairman. Thank you for our colleagues for being here today. As you've heard from both sides of the aisle, there is a laundry list of red tape coming out of your agencies that have negatively impacted Main Street businesses in my home district of Iowa, family farmers, and our communities across the board. Your regulatory cyclone that this administration has led has cost Americans $1.4 trillion. And just to put that into perspective, that's the entire GDP of Saudi Arabia and then some, just in the cost it's had ultimately to consumers. Luckily, the American people have spoken, and they've made it very clear that they are done with this type of regulatory regime that ultimately hurts people in my district and across the country. And while I remain committed to serving on behalf of all my constituents, both those on Main Street and in my rural communities, I think it's important that we start having a conversation about what the future looks like. First and foremost, we are looking for a financial leadership out of Washington that puts citizens first, promoting a competitive and diverse financial system through tailoring and flexibility, fostering innovation through dynamic systems based on thoughtful digital assets, as well as artificial intelligence legislation, evidence-based regulatory reforms based on a cost-benefit analysis, something that I think that this team has failed to do time and time again. And finally, the growth of capital formation, particularly in rural areas and small-town innovators across this country. Now, it's been only a few days since the American people made their voice heard and delivered a mandate to their government. The American people want new leadership that clearly puts them first. Can I get a confirmation from each of you that you will halt your disastrous, over-regulatory, burdensome process, particularly in the final hours of your tenure here, before President Biden leaves office? Will you confirm with that? Mr. Hsu.
We are going to follow the APA.
So you'll continue to make more regulations in your waning hours?
No, we'll do our
Thank you.
job. We're going to do our job, but we're not going to do anything that's going to be.
Chairman Harper.
So we have several things that we must do. We must pass an annual performance plan. We also must pass our annual budget. We do have one rulemaking underway. There are negotiations going on across the agency and all three board offices to reach a consensus on that where possible.
We'll hold you to that, but I appreciate the candor. Chairman Gruenberg.
Congressman, we have a number of pending rulemakings. On some of them, we've extended the comment period. We don't think any of them will be ready for action before the end of the president's term.
Then at that point, I would ask that you hold them until the new president comes in. Vice Chairman Barr.
Thank you, Congressman. We have three major rulemakings on Basel III capital rules, on liquidity, and on long-term debt on an interagency basis. And as I've indicated, I expect to work with my new colleagues at the OCC and the FDIC in the coming year on those measures to get their policy input, their perspectives.
Chairman Barr, I appreciate that. I hope that you will have heard what the American people have said overwhelmingly, and in the dying light of your time here, that you will rein in your overregulation, particularly coming from your leadership, or lack thereof in many cases. You've all engaged in an anti-crypto crusade during your time here, and I think it has sent a chilling factor to many institutions, particularly our digital assets and innovation, that they can't do business here in the United States. Do you each recognize that you have been a primary indicator in why, over the past 4 years, we've seen 14% of the industry leave the United States at a loss of more than $3 billion? Would you each accept some culpability in that? Your non-answer is answer enough for many of us here. The next generation of fintech may very well be in Singapore or the United Kingdom, because you have helped make the United States a second-tier place for digital assets and innovation to find home, and that is disappointing. Vice Chair Barr, your actions, I believe, have stifled competition and diversity in our banking system. And as a state with many small lenders, both credit unions, banking, and other, I believe that you need to do an examination on the cost that your regulations have done to the American people. Has your office provided an analysis of how much it has cost small businesses, particularly our small lenders, with your regulation?
I'm not aware of any such study, nor do I believe there's any such effect.
I would strongly disagree, and we've seen trillions of dollars in costs as a result of it. Just come to Iowa and ask my local bankers and credit unions. Thank you, Mr. Chair. I yield back.
We'll now recognize the gentleman from California, the ranking member on the Subcommittee on Capital Markets, Mr. Sherman, for 5 minutes.
Mr. Harper, you heard your colleague, Mr. Barr, say he's going to stay on to the end of his term. Of course, the president can move you from chair to member, but your term continues to 2027. Are you going to be serving out your term?
When I was confirmed by the United States Senate, I committed to serving through 2027. I remain committed to doing just that.
Thank you. And I hope the one thing that you do is allow the volunteers who serve on credit union boards to get reimbursed for their child care expenses as well as their travel expenses.
That is something that is on our rulemaking
Good.
agenda,
Good.
and it's more than just child care. We're also looking at elder dependent care.
Mr. Barr, I've served 28 years along with Mr. Meeks on the Foreign Affairs Committee. The biggest thing that could happen that committee would focus on that would affect you would be a blockade or invasion of Taiwan by China. You do a lot of stress tests. Can our major institutions survive what would be at least a temporary rupture in the U.S.-China trade relationship?
Congressman, we work with our regulated financial institutions to make sure that they are using the tools they have to do geopolitical
But have you done a stress test to see
risk
whether they can
analytics.
handle that stress? Yes or no?
We don't separately have a formal stress test like the capital
I
requirement
suggest
stress test.
that you do
on
that because
geopolitical
that's
risk.
the biggest international event that could occur. I know you've told me that you hope that your colleagues in the next administration are reasonable and that you want to join hands with them on whatever version Basel III takes. We've seen the Trump administration have nominees from Rubio to Gates. I know you hope to see appointees in your area that are consistent with Rubio. If your colleagues in Basel III end up being incredibly unreasonable, are you prepared to go it alone if that's what it takes to keep our banking system secure?
Congressman, as I said at the outset, I'm looking forward to collaborating with colleagues at the OCC.
Please don't dodge the hypothetical. We could have a Gates, we could have a Rubio. What do you do if you end up with unreasonable colleagues?
I'm not going to engage in the hypothetical.
Okay. We have the one issue that you and I have talked about a lot is the interest rate risk. You're wise to move forward with regard to mark-to-market on held-for-sale securities, but you're unwilling to do the held-to-maturity securities. The slender read is that FASB hasn't done that, but FASB is not responsible for the security of our banking system. Trump's economic policies, in the view of the Peterson Institute for International Economics, would raise inflation by between 4 and 7.5 points. That's way beyond what we've ever seen in this century. And that doesn't count the fact that the crypto folks are trying to partially displace the dollar, and that would weaken the dollar and have an even greater effect than the Peter Institute has calculated. I would urge you to take a look at Silicon Valley Bank and realize that interest rate risks are quite significant even on held to maturity securities, and would also point out that as long as you don't you have a system that is tougher on small business loans than on held to market securities, because small business loans are short-term or interest rate adjusted. So I would hope that you deal not only with the security of the system, but the bias that you have that caused Silicon Valley Bank and others to invest in long-term treasuries at great risk rather than local business loans. The gentleman from Iowa points out that your regulations can reduce economic growth. But he wasn't here in 2008, if memory serves me correctly, and to see what happens when we have under-regulation and the damage that did and is still doing to the social contract in America. And so I would hope that you wouldn't go all the way in the direction of economic growth if that means a risk that bailouts are going to be required. You have moved very significantly from your original proposal, and your increases in capital now are roughly half of what they would be. And I hope that you proceed, hopefully with good colleagues. I yield back.
Gentleman's time has expired. We'll now go to the gentlewoman from Texas, Mrs. Dela Cruz, for 5 minutes.
Thank you, Chairman, and thank you, witnesses, for being here today. I'm going to cut to the chase. We've heard a lot about regulation, Basel III, the Americans' mandate for less regulation, burdensome regulation. But as a female sitting in this room today, what really disturbs me is why, Chair Gruenberg, after 6 months ago, when you said you were going to resign, why are you still here?
Congresswoman, I indicated I would step down when a successor was confirmed. Since it does not appear a successor will be confirmed before the end of the president's term,
So basically what I'm hearing, sir, is excuses. Excuses for the reason that you're not going to be stepping down. It sounds to me selfish and self-centered, because if we did have somebody who was going to be confirmed and that they were going to come within this 6 months period, it would have been done so. But this is an election year. You've been here 9 of the last 9 years, and you know the process. We have a piece of legislation right now that was a reason for the notice of this hearing, H.R. 1574. And this legislation notes that you have been the chair for 9 of the last 13 years. You've overseen and contributed to the toxic culture at the FDIC. Your failure to address these issues has jeopardized the safety and soundness of the United States financial system, and you prioritized partisan rulemaking over collaborating to rectify workplace issues. So if you were in Congress and you were one of the members sitting up here today, would you vote for this legislation?
If I may say, Congresswoman, that's a hypothetical question, so if you don't mind, I'll take a pass on that one.
Well, I'll tell you that I will, and so will my colleagues, because your behavior in the Clearly Gottlieb report is disturbing and really, quite frankly, just disgusting. Sexual harassment, discrimination, that report quotes, "The FDIC has failed to provide a workplace safe from sexual harassment, discrimination, and other interpersonal misconduct." And, quote, "These incidents and many others like them did not occur in a vacuum. They arose within a workplace culture that is misogynistic, insular, and outdated." So the question now is for the other witnesses. I'm sure that you all have read this report. So for my other witnesses, if you had an employee with this kind of record that had this kind of information in a report about them, would you still want them on your staff, let alone leading that institution? Mr. Barr?
Congressman, I don't really have comment on the FDIC. I'll say we have a zero tolerance policy at the Federal Reserve for sexual harassment.
Zero tolerance. Zero tolerance. Thank you for that, Mr. Barr. Sir?
We've also adopted an effective anti-harassment program that's viewed by the EEOC as model, and we aim to have no discrimination or harassment whatsoever.
Thank you.
It's imperative that the workplace be safe and inclusive, and that anyone who's a wrongdoer is held accountable. It's critical.
So what I'm hearing is zero tolerance, and that there's repercussions for this type of behavior. And Chair Gruenberg, it is really sad that you would use politics in this day and age to stand by this type of report that clearly indicates sexual harassment, discrimination, among much more in this report, and still stand before us and give excuses as to why you have not resigned. With that, I yield back.
We'll now recognize the gentleman from New York, the ranking member of the Foreign Affairs Committee, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman. And let me just, before I begin, just to say how good it's been to work with you. I don't know if this is our last hearing or not, but we disagree vehemently on a lot of issues, but the opportunity to work together and to have a conversation, I've appreciated that and wish you well in your future endeavors. Let me start off by, I just can't help but respond to what I've just heard, talking about holding someone accountable. And I hope my Republican colleagues, I know when it came to Mr. Gruenberg, I was very tough. And I think that it was based upon a report that everyone had a chance to see. Everyone had a chance to see the FDIC report, but yet my colleagues on the other side seem to not want everybody to see the Gates report. I don't know, is that hypocritical? You're talking about holding somebody accountable, and you have within your own party someone who's being nominated to be the head of a federal government, Justice Department? Is that hypocritical? It worries me and concerns me, the job that you've done, but I am very concerned looking at the appointments that the president and co-president Musk has put together. I mean, I know co-president Musk has a lot of influence on the president-elect, and I'm concerned about that based upon, if you're not a one of those real-life TV people, I guess, that's been on television, maybe you're not eligible. And he dares to say anything about diversity, equity, and inclusion. When you talk about the most incompetent people that are being put in place, just look at him. It would be funny if it wasn't so serious. Let me go to what I wanted to say, and I know we're here to talk about bank regulation, but I also want to talk about a microeconomic issues level, because I think it's important for the record to be clear that our economy today is quite strong. Economic growth, job market indicators, and inflation are all moving in the right direction right now in the 119th Congress with the President Joe Biden. Fact of the matter is, in a recent speech, Chairman Powell said the current economic situation was actually, and I quote, remarkably good. So when we look at the economy that the next administration, President-elect Trump, co-president Musk will get, and they will inherit, I want to be sure that we don't forget that it's the policies and personnel that is in and put in place by President Biden that got us there. Post-pandemic, we could have found ourselves in a much worse position. I have previously asked Chair Powell about how the United States has fared compared with other democratic countries in recovery. I've got a chance to go around and talk, on my other hat with the Foreign Affairs Committee to see what's happening there. But his response was that our economy has outperformed other similarly situated nations. I think we know that is in large part thanks to President Joe Biden and also to the independence granted to the Federal Reserve to do their job. And I want to take this opportunity to state that I sincerely hope that independence continues and that we don't get caught up in politicizing the decisions of our central bank over the next 4 years. That's who we are as a country. And once we started gutting our institutions, then who we are as a country is in jeopardy. So I share the fear that many economists have voiced about the potential tariff policies that we could soon see implemented across sectors without any regard to diplomatic relationships and long-standing trade agreements. When the time comes to examine these policies, I sincerely hope that my Republican colleagues don't play politics. I hope they think holistically about our country and about our values and about those consequences, and not continue to just talk as I hear talking today, because if you're going to hold somebody accountable, hold everybody accountable. And I heard the president-elect, you're talking about sexual harassment and all of that, the president-elect, he's told you what he's thought about women and what he did to them out of his own mouth. Didn't even need a report to do that. He has stated it. Just go listen to what he said in that van or in that bus. He's been accused and found guilty of assaulting women. And you're going to talk about panels here? If you're going to hold him accountable, hold the president-elect accountable, hold Matt Gaetz accountable, hold your own colleagues who have been convicted of doing certain things accountable. Don't come in here and be hypocritical. I was straight with Mr. Gruenberg. I was against him for what he said. I had a report to base it on. Base it upon a report. I yield back.
Gentleman yields back. Now recognize the gentleman from Florida, Mr. Donalds, for 5 minutes.
Thank you, Chairman. I think obviously in light of what happened in America 2 weeks ago, the American people have spoke loudly. They have spoken clearly. They want a major shift in policy here in Washington, D.C., and they have asked for President Trump to come back to Washington and clean up the mess of the last 4 years. I'm not going to deliberate that much further. I could talk about that in many other places at many different times. Quickly, for all the witnesses, there are a host of pending rulemakings at your agencies, including FDIC corporate governance proposal, the FDIC broker deposits proposal, and the joint agency Basel capital proposal. Will each of you commit to pausing pending rulemaking and new policy releases until the incoming administration takes office and can make new appointments to positions that are or become vacant?
Congressman, as I said earlier, we have 3 major interagency rulemakings on capital, liquidity, and long-term debt, and I look forward to working with my new colleagues at the OCC and the FDIC on those rulemakings next year.
Congressman, as I indicated earlier, we have a number of pending rulemakings. We don't anticipate any of them will be ready for action prior to the end of the current administration.
As I noted earlier, we have to finalize the agency's biannual budget. We must also adopt an annual performance plan. We're on track to do those. We also have one rule under consideration and deliberation amongst all 3 board offices on succession planning, hoping to find consensus there if at all possible.
Similar to Vice Chair Barr, we don't intend to move forward on capital, liquidity, or long-term debt.
Okay, so as a follow-up, you all intend to just hold tight until the next administration is here, correct?
As indicated, we all have other rulemakings that are in train that are kind of normal business, like data collection that are a requirement. We have a process we're doing together to combat elder fraud. So those kinds of things I think will proceed, but on the major rulemakings that people are focused on, as I said, I plan to wait until my colleagues join with me next year.
And you know, without wasting time, I'm assuming everybody else, by nodding their heads, is in agreement with that. Good to know. Chair Harper,
Yes.
This past September, the CFPB issued a circular that created new expectations for how financial institutions must record and retain customers' opt-ins to overdrafts resulting from point-of-sale debit card and ATM transactions. I'm a little concerned that the CFPB has once again tried to change existing law without going through notice and comment rulemaking under the Administrative Procedures Act, and that their policy change will ultimately hurt consumers. Do you intend to direct your examiners to apply the new expectations described in the circular?
So the CFPB sets the rules for all 4 of our agencies, for the institutions under which we have consumer financial protection supervision. We'll be taking a look at that and providing appropriate guidance to our examiners.
Okay, all right. Vice Chair Barr, according to the Federal Reserve Board's latest supervision and regulation report, over 99% of banks were well capitalized, and the 2024 stress test revealed that large banks are well positioned to weather severe recession. They were tested against and stay above minimum capital requirements. On September 10th, you outlined changes that you would recommend in Basel III Endgame in a reproposed rule, which you said would result in a 9% increase in capital requirements for certain banking organizations. The proposal that was issued for comment in July of 2023 would have raised capital requirements for large banks by an estimated 19%, and an increase that you defended numerous times before in this committee. Why should members of this committee have any confidence that a 9% increase in capital is warranted or appropriate?
Thank you, Congressman. We took very much the comments that this committee and the public and the banking sector and other members of the public gave us. We took those comments into account, the 3 agencies working together to come up with the reproposal that I described in that speech. And I think it appropriately balances the costs and benefits of the rulemaking. I look forward with my new colleagues at the OCC and the FDIC to get their input on that, to get their understanding of it, and to move that process forward. I do think it's important to finalize the Basel process, to raise capital standards to a level playing field across the international system, and to take into account the risks that we saw from the global financial crisis that were not yet fully incorporated into our minimum requirements, as well as to reflect the lessons learned from March 2023 with respect to interest rate risk by being sure that unrealized losses on the balance sheet of banks are taken into account in capital.
But Vice Chair Barr, I'm out of time. Only thing I will say is that let's all be honest with ourselves. What happened in Silicon Valley Bank is not an issue of bank capital. That's an issue of the fact that they were not paying attention and the SF Fed was not paying attention. With that, I yield.
Gentleman yields. Gentleman from Massachusetts, Mr. Lynch, is now recognized for 5 minutes.
Thank you, Mr. Chairman. First of all, I want to thank the witnesses for appearing and for all your good work over the past couple of years. Let's pick up right where we left off on the fact that in spring of 2023, we had 3 large regional banks, not just Silicon Valley Bank, but also Signature Bank and First Republic Bank fail. And post-mortem reports by your offices and others indicated that it was a result of poor risk management. Matter of fact, Silicon Valley Bank hadn't had an official risk officer for 8 months. And that is problematic to a great degree. I have legislation that would require, banks to immediately appoint someone for that responsibility, because when investment decisions are being made, you want a risk officer at the table. The fact that there was no voice there, no official voice there, probably enhanced the likelihood that those banks would fail. But in July 2023, several months later, you all and others issued proposed rules to strengthen the capital requirements for large banks. And by the way, you had to exercise emergency powers to stop the crisis, to limit the contagion from infecting the rest of the banking community. And we had to have sort of a shotgun wedding where we had to rescue those banks. So it was a serious problem. And I think you responded in a serious way. In July of 2023, you came up with a proposal, Basel III Endgame, which under the original proposal, capital for the most systemically important banks would increase by 19%. That's big. And I'm sure that a hard and data-driven discussion arrived at 19%. And then, of course, the banks pushed back. We know how that goes. But the reproposal cuts it back to 9%. And, there were other measures that were also proposed. Mr. Barr, can you walk me through that, how we went from 19%, which was thought to be necessary in the wake of that crisis, then the banks squawk, and then all of a sudden we're at 9%, and we're struggling to get that done because, we're going to have this same problem again if we don't fix it.
Congressman, thank you for the question. I do think that the proposal that we all worked on together that I described in September would help make the financial system more resilient. It would add another $92 billion in capital to the system. That will make it safer. We adjusted the proposal to take into account the comments that we received from the public in each specific area. We didn't start with...
Most of those comments were from the banks. Most of those comments were from the bank, and they were vociferous. And this is not mom and pop sitting at home writing a letter about, capital reserves. That's just not the case. It's the industry. So that's what troubles me. I want banking regulators to be independent. The new administration, not so much. They don't believe that. They think that the president should have more authority and more influence. And so I'm just concerned about the independence of you all in making decisions. And I'm concerned that in this case where you went from 19% reserve requirement increase to 9%, that you were, buckling under to what the banks wanted. And that's not good. That's not good for our banking system.
Congressman, I attempted to make, and I know my colleagues attempted to make, our best independent judgment on what we thought we should do in response to those comments.
Yeah.
And I do think that the reproposal will significantly enhance, if completed, enhance the resiliency of the financial system and really address fundamentally the issues from March 2023, as well as the lessons about trading risk from the global financial crisis.
All right. Well, I've got 12 seconds left, Mr. Chairman. I'm going to yield back my time. Thank you.
Gentleman yields back. Now recognize the gentleman from New York, Mr. Lawler, for 5 minutes.
Thank you, Mr. Chairman. Like many of my colleagues, I'm alarmed that we continue to see an onslaught of proposed partisan rules by the federal banking agencies that will significantly increase costs to banks without commensurate benefits. Partisan rules that fail to be accompanied by substantive cost-benefit analysis, that lack an understanding of the cumulative effects they would cause, and whose adverse effects will be borne by American families and businesses of all sizes, including by increased costs and reduced availability of credit. Meanwhile, the information that has come out about the pervasive harassment, misogyny, and toxic workplace culture at the FDIC under your leadership, Chairman Gruenberg, is appalling. In the last year, the findings of the committee's investigation, clearly Gottlieb's independent review, and Wall Street Journal reporting have demonstrated the astonishing failures of your time in charge. You have no business continuing to lead this agency, preventing the necessary changes from beginning at this agency, and for your employees to continue to be a distraction. Yet here you are, astonishingly carrying on and making every effort to haphazardly jam forward partisan rules at the 11th hour in the waning days of this administration. And given that the FDIC put out a request for information, or RFI, on deposits at the same time as it has made a proposed rule on brokered deposits, it's clear that the FDIC will not have time to digest the public's input from the RFI before trying to move ahead with a brokered deposit rule. Chairman Gruenberg, are you not opening the FDIC up on multiple fronts to the Administrative Procedure Act challenge?
Congressman, we've been quite deliberate in putting forward both of the proposals you mentioned. The request for information on deposits is really a follow-on from last year's regional bank failures, where uninsured deposits were really the core risk precipitating those failures. Enhanced understanding of bank exposure to uninsured deposits is really the object of that request for information. The broker deposit proposal, and I would emphasize it's a proposal still out for comment, is really designed to provide simply greater transparency on bank reliance on broker deposits, which studies the FDIC has undertaken previously indicate can cause liquidity and risk factors for institutions. So they're two separate efforts. We think they both have value.
Do you believe by January 19th, your stated date of resignation, that you will be able to digest the public's input on these two proposals?
We're receiving comment on both. As I indicated, the request for information is simply feedback we're seeking from the industry. And on the broker deposit rule, we don't anticipate.
Yes, but that feedback is relevant. So do you think you'll actually be able to digest it before your resignation on January 19th?
I think we will have that information before there's final action on the broker deposit.
And are you going to try to take final action before you resign?
As I indicated, that's still out for comment, and we don't anticipate acting on it prior to the end of the president's term.
In recent months, the FDIC has been requiring asset management firms to enter into new passivity agreements with the agency or potentially be found in noncompliance despite the comment period of the proposed rulemaking still being open. Please explain exactly how you are coordinating both the NPR and staff letters with your colleagues sitting next to you.
Well, we've put out a notice of proposed rulemaking that deals with a rule the FDIC currently has in place that constrains our ability to require notice if a investment company gets a controlling interest in a bank. And the only thing this proposed rulemaking would do is restore the FDIC's discretion if an investor takes a controlling interest in a bank we supervise to require notice of that. We have sent letters to a couple of asset managers separately seeking an understanding of how their investments, controlling investments in FDIC-insured banks for which we're the primary supervisor, is exercised.
Vice Chair Barr and Acting Comptroller Sue, do you believe that the FDIC should be doing more? Yes or no?
I think that the existing system adequately protects the passivity agreements that we have with relevant entities.
You feel adequately informed?
Pardon me?
You feel like you have adequately been informed through this process?
Yes.
I think the agency should strive to have a similar view on the issue.
I yield back.
Gentleman from Texas, Mr. Green, is recognized for 5 minutes.
Thank you, Mr. Chairman. I thank the witnesses for appearing. I especially thank the ranking member for her commentary with reference to the independence of the Fed, which is exceedingly important. Let me remind us that we are currently being moved forward to rule by the plutocracy. The plutocracy consists of those who are very wealthy. They are the people that the millionaires look up to. The millionaires look toward the plutocrats for advice and consent. The plutocracy, to be efficacious, has to have power. It would do something as simple as avoiding advice and consent when persons are being nominated by the president for cabinet positions. Eliminating advice and consent would be antithetical to the Constitution. Plutocrats would do this. Very wealthy, conservative plutocrats, I might add. But I'm also afraid of what they are going to do or attempt to do with the Fed. Plutocrats would like to take charge of the Fed and require the Fed to respond to policies that would emanate from the plutocracy as opposed to policies that would benefit our democracy. So, Mr. Vice Chair, you are going to have a tough time in your current position. But I must tell you, one of your 7 members, Ms. Adriana Kugler, I'm very proud of what she did just recently. She stood up for the independence of the Fed. She has indicated the necessity for a Fed that embraces the notion that monetary policy should not be controlled by the politicians in the country. She didn't say those exact words, but that's the import. So, Mr. Vice Chair, I do ask you, are you prepared to take a stand against a plutocrat who is the co-president by virtue of having some $300+ billion in his coffer? It seems that money makes a difference when the plutocrats are in charge. So I have to ask you, are you prepared to take a stand against the plutocrats and stand up for democracy over plutocracy?
Congressman, the Congress of the United States has set out a clear mandate for us, a dual mandate on monetary policy to advance price stability.
Pardon me for being rude, but the question is not whether we will have a policy, but whether you will stand up for that policy. Are you going to take a stand against Mr. Musk, the co-president, and the president-elect when they demand that their policies be implemented as opposed to the Fed's policies?
Congressman, I'm 100% committed to the independence of the Federal Reserve in meeting our mandate to serve the American public. I am 100% committed to that independence, together with the accountability and transparency before this body and the Senate.
Are you in agreement with the proposition that the independence of the Fed is something that is global in its scope in terms of its impact? If the Fed no longer has the independence that it has today and should have, do you agree that it will impact not only the United States, but the global economic order if the Fed of the United States of America becomes controlled by the plutocrats?
Congressman, as I said, I'm 100% committed to the independence of the Fed. It serves the American people well. That's our job. And I think if you look at the data internationally at independence, that's confirmed not only in the United States but in other countries, that the independence of the central bank is essential to its meeting its mission.
Well, I thank you, and I encourage all of you, while your tenure may be short, may be brief, be strong. Do not allow the plutocrats to bully you. It's one thing to have a bully pulpit, and another thing to have a bully with a pulpit. I yield back.
The gentleman from Oklahoma, Mr. Lucas, now recognized for 5.
Thank you, Mr. Chairman. Chairman Gruenberg, this week I sent you a letter with other members of this committee regarding concerns I've heard about the FDIC's corporate governance proposal. The guidelines would be a significant departure from existing practices and clearly will need substantial revision. With your impending resignation and as we move into a new administration, is it your intention to pause on any further rulemaking actions or on both this or any other major rulemakings?
Congressman, as I indicated, that is a pending rulemaking that was out for comment, and we don't anticipate it being in a position to be acted on before the end of the president's term.
Thank you very much. That's a very wise observation. Vice Chairman Barr, we've had the opportunity to discuss my concerns about the Fed's capital proposals on several occasions. And as proposed, Basel III Endgame would disincentivize the U.S. bank participation in cleared markets at the same time that the SEC's Treasury clearing rule is coming into effect. In your speech from September, you said that the issues for client cleared derivatives would be fixed. And it sounds like you're willing to work through these proposals next year. Is that correct?
Yes, that's correct, Congressman.
I'll just note that I hope you're willing to take a holistic approach that considers related issues such as stress testing, cross-product netting, and the availability of liquidity during times of market stress. But continuing with you, Vice Chairman, on a related issue, as you know, I'm sensitive to the impacts of the cost of over-the-counter derivatives for end users. I know you've received feedback about the increase in capital charges for the types of uncleared derivatives that are used to hedge commodity prices and interest rates. As you continue to work through the process, will you also address the concerns from the end user community about how the market risk components will drive up their price of hedging?
Congressman, as I indicated in that speech in September, the agencies are still working through comments on all other aspects of the rule, including the aspect that you just mentioned. So I don't have an answer for you about the outcome of that review, but we are taking very seriously all the comments on all aspects of the rule, including the one that you mentioned.
Thank you, Vice Chairman. I appreciate that. This is an issue I focused on for a very long time, and these are tools that help businesses deliver affordable energy and affordable food and fiber that folks back home depend on, and it's just too important to get it wrong. And with those brief questions, observations, Mr. Chairman, and using my time very frugally, I'll yield back to you, sir.
We thank the gentleman for his efficiency. The gentleman from Missouri, Mr. Cleaver, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Harper, thank you. Thank all of the witnesses today for being here. I have become increasingly concerned about credit unions, or at least one credit union in particular. And as mentioned in your testimony, last month the Department of Justice announced its first ever redlining resolution involving a credit union. It was Citadel Credit Union, which has over 250,000 members. My concern is Navy Federal is the nation's largest credit union. In fact, it's larger than many of the big banks. They have 13.2 million members and $120-something billion in assets. And it has been clear in terms of investigations that they have discriminated through redlining, and that was a statement from our Justice Department. And they have, with great intentionality, refused to serve its Black and Hispanic neighborhoods, and they are doing so seemingly with some protection, I'm assuming. But here's the problem that I'm concerned about. Not just the discrimination, and I think the discrimination is obvious. Every report shows that they did, in fact, the numbers don't lie, discriminated against Black and brown citizens. But they're getting away with it. And one of the things I'm concerned about is, they're not involved with CRA. And maybe they ought to be subject to the same requirements as the banks, of which they are in many cases larger. What say you?
So first of all, let me say that I appreciate and share your concern about having a financial system that works for all Americans, regardless of what color of their skin, ethnicity, orientation, disability, regardless. Second of all, with respect to the size of Navy Federal Credit Union, if you looked at the size of institutions, it would be the 25th largest institution in this country. Currently, Congress has exempted federal credit unions from the Community Reinvestment Act. Overall, there are a number of states that have adopted rules recently, including those in Illinois and New York, to apply it. There are 4 other states that also have CRA that applies to credit unions. If Congress were to move forward on CRA and applying it to credit unions, I would ask for flexibility, given that there are many different types of federal credit union charters overall.
Yes, I'm talking about the largest credit unions. I mean, there should be some cutoff point. This is a thorny issue, and it places all of us in a bit of a pickle. But the larger credit unions, like Navy Federal, should have to be required to participate in CRA. That's what I'm saying.
Understood, and that's ultimately a decision that Congress needs to make. I can't make that as a regulator, but what we can do within our existing authorities is to apply fair lending laws and examine for fair lending laws. And in recent years, we've increased the amount of resources dedicated to fair lending to conduct more exams at larger financial institutions.
Well, do you know of any policies that have impacted the conduct of Navy Federal?
I'm sorry, I'm not understanding.
Nothing has happened. I mean, they discriminated, the records are clear as pure, undistilled discrimination.
So the CFPB is in charge of supervision for institutions above $10 billion in size. We have joined the CFPB in its examination of these matters. It's a supervisory matter currently undergoing review. I'm unable to comment on it.
The gentleman from Missouri, Mr. Lukemeyer, is now recognized for 5 minutes.
Thank you, Mr. Chairman. You know, one of the things I think is a common theme today, as you've seen, is the concern about regulations. And I think this last election was about regulations. People are mad as the dickens about the constant oversight and intrusion into their life and the cost of the rules and regulations come out of Washington. This administration, by their own figures, has promulgated $1.8 trillion now in this year, this fiscal year. $1.8 trillion. That's a huge tax increase. And you gentlemen are part of the problem, as my colleagues have talked about this morning. So, you know, as I'm retiring at the end of the year here, and I'm going through some of my old files and pitching stuff out. And I go through there and I see some of the issues we worked on over the years. SIFIs, choke point, CECL, enforcement of guidance. Every single one of those is about regulation, over-regulation, that we fought like the dickens to stop the nonsense of you guys, different entities here. So my question is, since you've had this mandate now, and this wake-up call as of a week or two ago, have you started thinking about stopping the onslaught of rules and regulations? Have you thought about going back and reviewing and trying to pull back on some of the rules and regulations, Mr. Barr? Have you started thinking about that at all?
Congressman, as I indicated earlier, we have 3 major interagency rulemakings on capital, liquidity, and long-term debt. And my intention is to work with my new colleagues at the OCC and at the FDIC in the coming year on those rules and to get their policy input and their perspective as I do that.
Mr. Gruenberg.
Congressman, it may be worth mentioning that there's a current law in place that you may be familiar with it called, the acronym is AGRIPRA. It basically requires the bank regulatory agencies on a periodic basis to go back and review all of the rulemakings they've done. And the agencies have begun that process and will be working on it.
So you have begun the process of reviewing and seeing if you can pull back some of those rules and regulations.
That's a process of review that's going to take place, I think, over the next several months.
Okay.
And it's supposed to result in an outcome.
Mr. Harper, have you started looking at trying to pull some of this back a little bit?
So certainly on the CECL rule, we did a regulatory phase-in. We had no ability to change it because of the way the statute was written, but we worked to phase in the regulatory capital requirements to make it easier. Fully agree with my colleague, Mr. Gruenberg, on the AGRIPRA process. The NCUA is not a party to that process under the law, but we voluntarily commit to the decennial review. In addition to that, we have a 3-year rolling review of all of our rules and regs, and we certainly collect comments and where possible, work to fix the size, scale, and scope.
Have you started looking and trying to pull some of this stuff back?
Yeah,
Are you listening to the voters at all?
Yes.
The people, the businesses that are impacted by your rules and regulations?
Yeah, in all my meetings with bankers, these issues have been raised. I have strongly encouraged them to participate in the AGRIPRA process and to be as specific as possible.
You know, part of the problem, you know, we had the Silicon Valley guys and all the other banks in here last year or whenever they went down, and one of the things that was said was that the banking system before that was very resilient, very sound, well capitalized, and yet these went down. So it begs the question, why are you adding more rules and regulations when probably the problem was, and the regulators at the time even admitted they didn't do a very good job of oversight. So you're punishing the ones who don't need to be punished because of your own inadequacies, the way I look at it. So it's very frustrating to see that there's continued to be this onslaught of rules and regulations that I hope stops right now and you start pulling some of this stuff back. That being said, I saw in the Wall Street this morning an article about paper checks popularity but keeps scammers happy. Our newest problem is we've got check fraud running rampant again. Mr. Gruenberg, what do you see happening on that? What are you trying to do about it? How are you working on the problem?
We hear about that from the bankers as much as any issue. And what's old is new again. I mean, check fraud used to be a thing in the past, and it has come back in various forms, some of it in the traditional forms of check fraud, others using technology, check washing to do it. We've established a hotline for any banker to call that has a difficulty. Some banks have difficulty with the corresponding bank getting cooperation. We try to assist them. There's also an interagency group that is trying to focus on this issue, but this is a big concern for a lot of bankers.
Very good. Sometimes, are you working with the check companies at all to see what's to make it more difficult to launder or to work, to fiddle around with the checks and make sure that they're, if you try and do something on there, all of a sudden the whole check, like Mission Impossible blows up or something, I don't know.
It's a good question. Let me look into that.
Okay, thank you very much. I yield back to the chairman.
Exploding checks. All right.
Well, I'm trying to think outside the box, Mr. Chairman. I'm trying to get a laugh. It's just such a dull, boring session here this morning.
All right, the gentleman from Illinois, Dr. Foster, is recognized for 5 minutes.
Thank you, Chair McHenry, and I think that last discussion is a perfect example of why we have to move as quickly as possible to the future with secure electronic financial transactions and secure digital identity behind it, so that this sort of identity fraud through check washing just becomes a thing of the past. And I was happy to see the CFPB recently finalize the open banking rule on personal financial data rights. I believe this will increase competition in the financial system and give consumers more control over their sensitive financial data. But one area that may benefit from your agency's input relates to the conditions under which a bank can deny a data request from a third party and how liability would be distributed in the event of a data breach in one of those third parties. Vice Chair Barr, has the Federal Reserve been considering these issues?
We have been consulting with the Consumer Financial Protection Bureau on its open banking rule, and I agree with you that it would be useful for the prudential regulators to help provide clarity regarding the circumstances under which a bank, for safety and soundness reasons, for BSA AML reasons, protecting the financial system, can choose to not share that information. That would be a useful thing for us to do, and we are working on that kind of issue now.
Yeah, do you think in terms of the liability division, is there something that legislation may be needed on that, or do you think all the authorities are in place?
I'd have to get back to you on that, Congressman. There is an existing allocation of liability, and the CFPB rule doesn't change that system of liability. But I'd have to get back to you on whether there are additional measures that might.
If you could respond for the record, that's going to be an issue that will stay with us. Chair Harper, last November there was a cybersecurity attack that affected more than 60 credit unions in more than 40 states. Would you quickly describe what happened and how this relates to Congress giving the NCUA the same authority that banking regulators already have with third-party vendors of its regulated entities?
So certainly, the lack of vendor authority is a growing regulatory blind spot that the Government Accountability Office, the Financial Stability Oversight Council, as well as the NCUA's Inspector General have all called on Congress to close. I agree with them on the need. With respect to the particular incident that you outlined, it was not just the vendor, but it was the vendor's vendor that had the attack. We were days behind in being able to actually assist the 60 credit unions that were directly impacted and lost access to core service provider, doing core services through their core service provider during that attack. That is an example that affected approximately 100,000 members with $1 billion in assets. There are some obviously much larger core processors. This is a national security issue.
That's right. I agree completely, and I really hope that's an opportunity to make bipartisan progress on our legislation.
And I thank you for the legislation you've introduced.
But this regulatory gap, it's dangerous for consumers, obviously, and it's also dangerous for millions of our military service members, the veterans and the families who use credit unions here and abroad. Yesterday, I sent a letter to the House Armed Services Committee raising concerns about exactly those risks. Do you agree that NCUA's lack of vendor authority puts the readiness and the financial stability of our service members at risk?
Yes, there are risks.
Yeah. Well, thank you. This is an issue we just should have dealt with a while ago. Now, Acting Comptroller Sue, we have discussed the remarks you made last year suggesting that your authority to oversee third-party vendors of banks may be insufficient. and that you may need tools to oversee fourth and fifth party vendors, given how the supply chain of supporting banks has become much more complex. And this was apparent with the collapse of the fintech synapse earlier this year, when thousands of consumers, including some of my constituents, were frozen out of their bank accounts. So what lessons have you learned from the synapse bankruptcy, and what steps should we be taking to better protect fintech customers in the future? And again, do you need any legislation on this?
Thank you very much for the question. This is a very important issue, given how banking is evolving, especially between banks and non-banks. For the banking agencies, I think using our current authorities, we are able to hold banks to a standard where third-party risk management is done in a way that can ensure safety and soundness. And we recently put out an RFI specifically focused on bank fintech relationships to make sure that the healthy arrangements are ones that are in existence. I do think there is a gap for non-banks in terms of the regulation of non-banks. Most non-bank fintechs are regulated as money services businesses by the states. And that regulation and oversight is highly uneven across the states. It's patchwork across the country. I do believe that a federal standard that levels up that regime would be helpful and would have helped to prevent some of the problems that your constituents are having now.
Thank you.
The gentleman's time has expired. The gentlewoman from Indiana, Ms. Houchin, is now recognized.
Thank you, Mr. Chairman. Thank you to the witnesses for being here to testify. I'm going to focus my comments today on Chair Gruenberg. Mr. Chairman, I just want to ask you, what in the heck is going on at the FDIC?
We had reports last year of misconduct. We, at my initiative, engaged an independent third party who undertook a detailed review that indeed found serious issues at the agency, made a series of recommendations, which we are now in the process of implementing.
Has anyone been fired?
I can tell you that in the last 12 months, there have been 16 disciplinary actions, 8 of them involving removal or proposals to remove, and these are at executive and manager
Has
level
anyone been
positions.
fired?
The
Yes
answer
or
to
no?
that is yes.
Yes. And you, as the chairman, have been there overseeing the FDIC for 9 of the last 13 years, and it is under your watchful eye that this toxic workplace environment has been allowed to persist, and a rampant boys' club culture that has led particularly your female employees to feel unsafe, dismissed, and unheard. Will you now today take responsibility for that?
I have done that previously and committed to implement all the recommendations of the third-party report.
But you understand the frustration that the American people may have that this has been under your watch, and it is consistent with President Biden's actions of not really firing anybody that is doing a terrible job. After the release of the report, you said you intended to resign upon confirmation of your successor. However, this has not occurred, and just yesterday you said you intend to remain in your position until January 19th, the day before Trump's inauguration. Chair Gruenberg, there are significant issues at the FDIC that are highlighted in the report. You've stated your intention to resign. Why do you believe it's appropriate to continue to proceed, particularly with these, not to mention all of the politically motivated rules that you're trying to implement and these major rule changes when you cannot address and haven't addressed in 9 of the last 13 years major workplace culture problems within your agency?
Congresswoman, as I indicated earlier, I previously said I would step down when a successor was confirmed. When it became clear that that's unlikely to happen, I indicated that I would step down at the end of the president's term.
The report also suggests that your employees don't feel they're taken seriously, and you being here today, I can see why. You refusing to resign and step aside and allow someone else to take over and try to fix the problems that occurred under your watch, how can you justify that when it appears that the workforce lacks trust in your leadership?
We have worked very hard to follow up on all the recommendations, engaging not only senior leaders at the FDIC, but employees throughout the agency. We believe we're making significant progress in implementing those recommendations, and I detail a good number of them in the appendix to my testimony.
I really wish that your employees were here to testify before us so they could speak up and have a voice, because I really don't feel like as the leader of this organization that you're giving them a voice with the opportunity to testify here today. I think it's just more of the same. The FDIC plays a critical role in maintaining confidence in the banking system. However, the toxic culture that has been allowed to persist under your leadership undermines the public trust and industry trust in your ability to follow through on your core mission. Why do you think remaining as chair is the best approach when really, how is that restoring trust with the FDIC among the American people? To allow you to stay and to be here today to testify, really not standing up for the employees that have suffered under your workplace culture.
We have committed, and our board has been working cooperatively to implement all the recommendations in the third-party report.
How many of those have been implemented so far?
A number of them, let me get back to you with this, specific number, both what we've done and what we have in process.
I've just got a few seconds left in closing. Your actions and lack of leadership and accountability during your tenure at the FDIC are unacceptable. I would urge you to consider tendering your resignation today. There are clear, widespread issues that have only gotten worse under your leadership, and in the aftermath of the independent report, you've done close to nothing. It's shameful and embarrassing, and I look forward to your resignation in January. That truthfully should have happened months ago. I yield back.
The gentlewoman from Ohio, Ms. Beatty, is recognized.
Thank you, Mr. Chairman and Ranking Member. First, let me join my other colleagues in thanking our witnesses for all of their services over the last 4 years of this administration to stabilize our financial system, to support community financial institutions, and overall to protect consumers. And I mean that. I've enjoyed our one-on-one meetings, and I've enjoyed the way you have performed here in testifying. Before I ask my first question, let me just say that my line of comments will be dealing with hypocrisy. The hypocrisy of Republicans demanding Mr. Gruenberg to immediately resign and holding him accountable for misconduct at the agency, but turning a blind eye to similar misconduct by members of their own party, including the president-elect. Now, let me also go on the record. As an earlier colleague on the other side of the aisle said, as a female, she's bothered. I too am bothered. I have posed the questions. I have no tolerance for any type of harassment or sexual harassment to any person, and especially women who are working and have to be in an environment that makes them feel unsafe or uncomfortable. So I want to go on the record with that. And many of my colleagues over here, from our ranking member to our chair of the small business, asked very tough questions about having a culture that people should be able to work in. Now, with that said, I have a real problem with my colleagues on the other side and hypocrisy, as Mr. Congressman Meeks brought out. So bear with me. Pandora's box has been opened. Mr. Gruenberg, have you had any person, female or male, on your staff accuse you of rape?
No, Congressman.
Have you had any female on your staff accusing you of luring them into a hotel room or your office and making sexual accusations to them personally?
No.
Have you ever made a personal sexual harassment comment to a female on your staff or put them in a position where you didn't care about their personal safety?
No.
Okay, with that said, while I also understand that you have a responsibility, while I may not have agreed with the timeliness of your responses, I do respect that you took ownership. I do respect that you said you understand, quote from the transcript of the last questioning of you, that you now understand that perception basically is reality and that you will deal with it. People have been terminated. You've taken a strong position. I may not like that you didn't take it earlier in doing that. But with that said, I think the hypocrisy is that we have a president-elect who has appointed or nominated for appointment a Secretary of Defense who has been accused of rape, who has been accused of luring a staff member into a hotel room. For 8 hours, she did not return to her hotel room with her family and children and said she had been raped, and there's no accountability. The president-elect said he'd stand by Pete Hegseth in this, and it's been brushed under the table. So to my Republican colleagues, I hope that they ask the same questions and demand him to not accept this appointment. I have a hard time with hypocrisy. I have a hard time because wrong is wrong, whether you are Democrat or Republican. But to have a president-elect not make the same statements as you had, but to be very blatant in saying he can basically do whatever he has to do. So this message is to all of us, but more importantly, to my colleagues on the other side. You know, what's good for one side is good for both. Let's hold everybody accountable, because also it is harmful to be against DE&I. That is a form, in my opinion, of standing against women who have make less money, who've not had the same opportunities. And so when we pushed for DE&I, it was well accepted when Congresswoman, then Chairman Maxine Waters pushed for it. We had somebody that was a ranking. They asked questions and went on records. Our chairman now even said that at the opening of this, he would continue with DE&I and we would have it. That never happened. It never happened. And now we are having institutions having their dollars taken away for the very mention of DE&I. I know my time is up and I yield back.
Gentlelady's time has expired. I now recognize myself for 5 minutes. Vice Chair Barr, I want to thank you for 3 things. Number one, your accessibility to me, our conversation, our back and forth. You know I've been critical of the original proposal, but I really credit you for your willingness to listen, both to members of Congress and the public. I want to also thank you for your announcement at Brookings about broad and material changes. That reflects, again, that you listened to the 90% of the comments that came in that were negative, that were critical of the original proposal, and I appreciate your willingness to listen to that. Finally, I appreciate the fact that you've committed here today to waiting until the new regulators in place to collaborate on, as we discussed, a durable and lasting proposal that provides certainty on this, but also that takes into account the comments. When I was recently in Basel, Switzerland, and I discussed with the Basel Committee the original proposal that you unveiled in July of 2023, they acknowledged that that original proposal was inconsistent with the capital neutrality of the Basel Agreement, and they acknowledged that what you originally proposed was actually gold plating of capital standards on U.S. institutions. Will you commit in a re-proposal that you will commit to a more capital neutral approach that actually does bring our standards in line and harmonizes our rules with the international banking standards?
Congressman, first of all, thank you for your very kind comments. I've also very much enjoyed our give and take over the last 2.5 years, and appreciate also your willingness and to go with Congressman Himes to Basel and really talk to folks in the Secretariat. I think that's a terrific thing for Congresspeople to do. In terms of the capital proposal, as I said, I put forward, along with my colleagues at the FDIC and the OCC, a re-proposal in September. I'm looking forward to getting input from new colleagues at the OCC and the FDIC, continue to engage with my board where there was broad support for that re-proposal. I haven't made any determination about the right set of trade-offs going forward. I look forward to getting input from others and then to having the comment. I can't commit to a particular thing until I understand the full range of public comments and the right way to address
Well,
it.
as we discussed, I see utility and international harmonization, but the goal should be economic growth and American competitiveness, and I urge you to keep that in mind with your new colleagues when they come in. Vice Chair Barr, one other question. I introduced the Congressional Banking Regulation Priorities and Accountability Act, and that requires enhanced consultation by federal regulatory agencies with Congress and the public with respect to your engagement with these global governance bodies, like Basel Committee, like the Network for the Greening of the Financial System. I think we need to protect U.S. sovereignty when our central bank goes and negotiates deals overseas. My legislation would ensure that Congress can conduct proper oversight when the Fed or the Treasury participates in these international standard-setting bodies. I shared that legislation with the Basel Committee. They said that they had actually read it. They were aware of this proposal. Have you or anyone at the Fed examined this bill, and would the Fed be supportive of more transparency with Congress when the Fed goes and enters into agreements overseas?
Congressman, first, let me just say I think the oversight of this body is absolutely essential. People often ask me, isn't it hard to go up there and testify? And I say, yeah, it's hard, but it is an absolutely essential part of holding us accountable and providing transparency to the American public.
Right.
And so I'm committed to that. I'm happy to look at the legislation in more detail, and you and I can chat about it and see if we can find common ground or not find common ground on it.
Thank you. Chair Gruenberg, so some of my constituent banks are located in poverty-stricken areas. They can make all the viable loans available in their assessment area and still not meet the Community Reinvestment Act 50% rule, since the amount of the loans are so low. In order for them to keep their doors open, they have to buy participation loans from out-of-market banks to supplement their loan volume. The total of those loans are higher than the assessment area loans available, and therefore they can't reach the 50% in area volume. So the FDIC has an examiner now that is giving our rural banks low marks. Can you address this, and why is this examiner changing the assessment of these banks when previously they were getting high marks on CRA?
Congressman, I'm aware of the issue. I met recently with the Kentucky bankers. We are following up with them and see if we can find a way forward here.
Yeah, the bottom line is, when you have a prior FDIC examiner that's giving our rural banks positive marks on CRA, and now we have a new examiner, and it's totally different, it's whipsaw. That is not good bank supervision, and these banks are providing all the loans in poverty-stricken areas. So I urge you to fix that problem before you leave. With that, I yield. And the next questioner is the gentleman from California, Mr. Vargas.
Thank you very much, Mr. Chair. I appreciate the opportunity, and again, I want to thank the witnesses for being here. Vice Chair Barr, I think that when you first started today, you said that the banking system is sound and resilient. You still stand by that?
Yes, sir. It is sound and resilient, and as I noted in my testimony, there are particular areas of concern that we pay attention to and particular institutions that we focus on, but overall, the system is sound and resilient. Great.
Does anyone disagree with that today? No, okay. Then I do want to read this. This was actually a presidential address from a president in his second term. The government's top economic experts warned that without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold. More banks could fail, including some of your community. The stock market would drop even more, which would reduce the value of your retirement account. The value of your home could plummet. Foreclosures would rise dramatically. And if you own a business or a farm, you would find it harder and more expensive to get credit. More businesses would close their doors, and millions of Americans could lose their jobs. Even if you had good credit history, it would be more difficult for you to get loans. You need to buy a car or to send your children to college. And ultimately, our country could experience a long and painful recession. He goes on. Who was that president?
Sorry, who made the statement?
Yeah.
I'm not sure who made the statement.
Does anyone know who made that statement? It was George W. Bush. Because of the financial meltdown that we saw, because of some of the regulations. Now, you live long enough, you see cycles. And my colleagues on the other side say, there's too many regulations. Get rid of the regulations. Let's run hard. Let's run fast. Let's make money easy to get. Now, they did that. That happens, and that'll probably happen again. And then we'll get into another cycle like this where a president will stand up and say, hey, guys, unless you do something now, we're going to find financial calamity. And then what happens, of course? Usually it's the Republicans that do that, and then usually the Democrats come back in, fix the economy, hand it back over to them, and they're saying there's too many damn regulations. Well, those regulations made sure that we had a sound and resilient banking system. And so I want to appreciate all the work that you've done to make sure that when we hand this over to the next president, our president today is not, who happens to be a Democrat, doesn't have to make a speech like this to say the system's collapsing. Unless the Democrats and the Republicans work together, we're going to go into recession, potentially a depression. And of course, our president's not going to say that because we're in pretty good shape. And again, I thank you for your service on that. You get a lot of hassle on the other side, but you're handing over a very strong economic system at the moment. That's why I was kind of surprised that the new president's going to put George Santos in as the new treasurer. I'm just kidding. But I'm almost not kidding. What an easy step that is from some of these appointments. And that does cause real fear for me and others, I think, the appointments that we're going to see. But again, that's separate. I do want to ask about climate-related risk. All of you have made statements about that there is potentially a risk in there. Could you tell us how you're going to continue to take a look at that risk? Now, you're not climate activists, and again, you're not policymakers, but that risk is inherent in the system now. Could you tell us what you're doing to combat that, or at least to figure it out? Yes, Mr. Barr, go ahead.
Congressman, the Federal Reserve has an important role in this space, but a narrow role, and that's to make sure that banks are preparing to understand, measure, monitor, and address climate risks as they affect that financial institution. We've taken two significant steps. One of those is to engage in a climate scenario pilot exercise to begin to work with banks to understand how they're doing that now. And the second is to issue guidance together with our colleagues at the OCC and the FDIC for large banks over $100 billion to use the same kind of risk management practices that they apply to other risks to future-related climate risks. And I think those measures have been quite helpful in addressing the risks that we see.
Well, thank you. My time is up, and I hope you continue to address that. Thank you. I yield back.
Gentleman yields. The gentleman from Michigan, Mr. Heisinger, is now recognized.
Thank you, Mr. Chairman. I'm going to get right into it. Acting Comptroller Sue, by the way, first and foremost, I think that it's a shame that you did not get your day in the Senate for a full confirmation. That should have happened. But you co-chaired the Special Review Committee created right after those Wall Street Journal articles hit almost exactly a year ago when they came out. And last time you appeared before the committee, the Cleary-Gottlieb report was released by the FDIC. So do you still stand by the findings and recommendations of the report?
Yes.
Okay. But in the Special Review Committee, you oversaw the Cleary-Gottlieb investigation. That Special Review Committee was terminated by the FDIC board in May 30, correct?
Correct.
All right. Chairman Gruenberg, it was a year ago. The board recognized the need for a third party to oversee the investigation, but ultimately decided that the cultural transformation could be and should be left in your hands after the report was all said and done. It then took you and the FDIC 3 months to hire this quote-unquote transformation monitor as recommended by Cleary-Gottlieb. Frankly, sir, I believe you've been stiff-arming this committee, my subcommittee. You have dragged your feet, and here we are today. The committee asked you multiple times to testify, and the 5 minutes that you gave us here today and the 5 minutes that I'm getting right now is not nearly sufficient for what we have seen transpire over the last year, and frankly, for the decades prior to that. And instead of hiding behind the agency process, you could have taken the opportunity to be transparent. You claim to be transparent. But instead, we have an 8-page addendum to your written statement addressing the workplace culture. Coincidentally, I might add that that's after the committee released its report. You sat for a interview with our committee staff back in, I believe it was March or April. And then when we asked you to do so again, when we asked you to come before our committee, our subcommittee and our full committee in September, you refused to do so, saying, I'm going to be there in November. We then asked for another transcribed interview. You said, yes, you would do that. How'd that interview go?
believe a date has been scheduled for that to occur.
That has not happened as of yet, and we were hoping to get that done so that we could have a more full picture that we could do on our committee report. But again, you dragged your feet on that. This is the first time that you've appeared before the committee since May 15. So you are overseeing a, quote, cultural transformation of a toxic workplace that you contributed to and frankly tolerated. And this is not new information. You and I had this public conversation. We've had a private conversation. You've made employees cry. You made employees feel verbally abused. The list goes on and on. But in your interviews with the committee staff, you don't seem to remember any of it. And again, we only had the one opportunity back in, I believe it was March. So do you really think an 8-page addendum is enough to cover all the changes that have to be done and need to be done under your 20-year tenure at FDIC?
The addendum was an effort in a concise way to summarize for the committee some of the
So it would have been great to have had maybe a committee hearing about what's going on with the FDIC.
We can certainly provide the committee a more detailed list and
Sir, that's what we've been trying to do for 6 months.
Well, we can certainly.
We launched our own committee investigation a year ago. A year ago, and you've stiff-armed it. So instead of leading the agency when you should have a year ago, I'm not sure if it's selfishly stated. I mean, this is an organization that you say repeatedly that you love. I'm not sure if it was for your own purposes or if it was more for the purposes of the Biden-Harris administration and the banking agenda that you are pushing and they are pushing. And Mr. Barr, we heard here today that Basel III is likely not to move forward this year, correct? It's a nod, it's an affirmative.
Correct.
Okay. So there's only 6 weeks left. Knowing that, Chairman Gruenberg, what are you still doing at the FDIC?
Carrying forward under the supervision of the entire board, the implementation of all the recommendations of the third-party review, which I initiated. And I've indicated, as you know, Congressman, that I plan to step down at the end of the presidency.
That, frankly, you're stepping down on January 19th is too little, too late, far too late. They don't need your vote at FDIC. Rohit Chopra took care of that with Basel III. And like many of us have told you today, your retirement is long overdue. My time has expired, and I yield back.
Gentleman's time is expired. Now I want to recognize the gentleman from Illinois, Mr. Kasten, who was a very productive and helpful colleague on the Codell to Basel. 5 minutes.
Thank you very much, Mr. Barr. You were pretty good yourself. We had a wonderful trip, super educational, to meet with all our European regulators. And I guess the 3 things that really struck with me. Number one, it was refreshing and educational to hear all the European banks tell us that Basel III tips the scales too far in favor of big U.S. banks. And it's worth having that perspective. Number two, every single European financial regulator is jealous of the U.S. economy. And I don't think it should be lost on any of us that in 2008, George Bush handed an economy in free fall over to Obama, who led the longest sustained recovery in our country's history, who handed that over to Donald Trump, who promptly took credit for it, who then handed off the largest economic collapse since the Depression to Joe Biden, who has created an economy that the rest of the world is jealous of. And I have no doubt that we are just a few months away from Donald Trump taking credit for that as well. But history will credit those of you who were stewards over a very challenging time, and grateful for your service. The third thing that was raised was the Europeans wonder why we act like such children when it comes to climate change. They understand it. They wonder why we're not serious about it. We have debates about things that are settled science, and there's no good way to answer that as an American. And I want to just sail into some hard issues that all of us have to do a better job of. Before I start, just Vice Chair Barr, Comptroller Hsu, and Chair Gruenberg, do all of you agree that climate change poses a potential threat to the safety and soundness of banks and the stability of our broader banking system?
Yes, it can do so in the future. We're still learning about its effects in the current environment, but it is a threat that we take seriously.
Well, and I'm asking because, as you know, in October 2023, the FDIC and the OCC essentially affirmed that point, so I just want to make sure that's still our point. And that was, of course, the rationale behind the Basel Committee on Banking Supervision's proposed climate disclosure framework. But I've been really disappointed by this reporting. I think Bloomberg has led on this, that U.S. regulators led by the Fed have obstructed progress on those international frameworks, and has said that the Fed is refusing to support the Basel Committee's revised climate disclosure framework. So, Vice Chair Barr, why is the Fed opposed to that proposal, which will give investors and regulators more information about climate-related risks among U.S. banks?
Congressman, we've indicated that we're still looking at the proposal. The proposal went out for public comment. The Basel Committee got public comment back. They've made revisions that are under consideration. So that's a work in progress. It's not something that the Federal Reserve is...
My understanding, and you'll correct me if I'm wrong, I'm sure, is that other members of the Basel Committee have agreed to numerous changes. They've gone from quantitative to qualitative disclosures. They've made some of the disclosures voluntary. Is that sufficient, or are you still opposing in light of the concessions that have been made?
Congressman, as I said, we're still looking at the revisions that have been made and considering whether they're a good fit in the United States or not. That's a position that all three agencies have taken. We're still looking at that. We haven't made any decision about it.
Okay. Well, you'll appreciate that as I said at the start, I deeply appreciate all your service. We are also about to have an administration full of climate deniers. The nominee for the Department of Energy who testified before this committee is an outspoken climate denier. It is not going to get better. The Europeans are going to be wondering again why we have regressed as children on disputing the laws of physics. So I guess, Vice Chair Barr, do you believe that it is the Fed's responsibility and/or within the Fed's mandate to address climate risk that is originated by banks under your supervision but then distributed elsewhere in the system?
It's our responsibility to make sure that the banks we supervise and the financial system as a whole understand the risks with respect to climate change's effects on financial conditions, appropriately measuring those risks, monitoring those risks, and taking actions on those risks.
Well, and I guess we got a little bit of time left, but I just want to frame the question that we had with the ECB, which is that as a regulator responsible in the first instance for overseeing the GSIBs, if a systemically important financial institution is holding a significant climate risk on its books, and it offloads that risk onto somebody else in the system, and that person does not understand the risk, are we better off as a regulator to protect the overall system or to disclose that risk such that the GSIB is going to have a hard time offloading the risk because there will be an informed buyer? How should we be thinking about that? Because we're seeing risks being offloaded onto Fannie and Freddie, risks being offloaded on the insurance industry, risks being offloaded onto homeowners who are the least sophisticated players in the system.
Gentleman's time has expired. You'll be able to have an answer in writing.
Would welcome any comments for the record, because I think it is fundamental. Yield back. Thank you.
Gentleman yields back. Gentleman's time has expired. So the gentleman from Texas, Mr. Williams, is recognized for 5 minutes.
Thank you, Mr. Chair, and thank all of you for being here today. Vice Chair Barr, in your September speech to the Brookings Institute, you provided an update on Basel III capital rule and expressed optimism that the Federal Reserve would soon release the final long-term debt rule. Now, however, as many of my colleagues have pointed out today, the re-proposal for Basel has not yet been issued and now seems unlikely to be finalized for the next administration. So, given the clear interconnection between Basel III endgame rule and the long-term debt rule, can you commit to pausing joint rulemakings with other prudential regulators until new appointees from the incoming Trump administration are in place?
Yes, Congressman, the major rules that we're working on, liquidity, long-term debt, and capital, I intend to take up in the next year with my new colleagues at the OCC and the FDIC to get their policy input and perspectives and to see if we can reach consensus. If we have broad consensus on the Federal Reserve Board with these measures, I'd like to see if we can reach consensus with the new regulators when they're in place, and then proceed to have a set of durable rules that really serve the American public.
Okay. De novo banks are small, newly established institutions striving to enter the market and establish themselves. They play a crucial role in fostering innovation and meeting the needs of unserved communities. However, one of their biggest challenges is growing their asset base, and the critical way they can build assets is through mergers and acquisitions with other small banks or non-bank entities. My concern is that the OCC's increased scrutiny of the merger process may deter small banks and de novo institutions from pursuing strategic mergers. The added regulatory burdens, including the requirement to demonstrate public benefits and the focus on asset size thresholds, could make these mergers more difficult, and as a result, the OCC's changes could create higher barriers to entry and limit banks' ability to grow, potentially leading to greater concentration in the banking sector and reduced competition. So, Mr. Sue, how can you ensure that your changes to the merger review process won't unduly burden the de novo banks, which may lack the resources to provide the extensive documentation your new rule requires?
So I should start off by saying I'm strongly supportive of a dynamic banking system and of de novos. With regards to the M&A policy statement that we put out, it was not intended to provide either a red light or a green light on mergers. It really was to provide clarity and transparency as to how we evaluate the statutory factors for an appropriate merger. That's a merger that's pro-competitive, pro-community, pro-financial stability. So it's really to just provide that clarity. That was the key purpose of putting out that policy statement. With regards to de novos, we have evaluated our processes internally to streamline those as possible. I think it is useful to look abroad at examples of how other jurisdictions approach that, because I do believe more de novo activity in this country would be healthy.
Okay, thank you. One of the most common themes that I've seen coming from the regulatory agenda of the prudential regulators in the Biden administration is that there's been little to no thought into how the onslaught of rules and regulations will affect community and mid-sized banks, many of which I represent back in Texas. As I also chair the Small Business Committee, which is important to us. So what you've been putting forward will continue to harm smaller operations, continue to raise their costs and compliance hours, and decrease the availability of credit for those who need it most. So one proposal I would like to focus on this is the FDIC's broker deposits rule, which broadens the definition of broker deposits, makes it harder for banks to qualify for exemptions on broker deposits, and impose additional compliance and cost burdens on banks. So as it applies to community banks, this rule only makes things worse by increasing compliance costs and DIF assessments, leading to higher fees for consumers and reduced lending capacity. So quickly, Mr. Gruenberg, with this rule not being based on any real analysis, how can you ensure that small and mid-sized banks will not be hit with increased costs and face a reduction in valuable resources for their consumers and trickle down to Main Street America?
Congressman, the FDIC has conducted two studies, one in 2011, another in 2019, that showed there are higher risks associated with banks that rely on broker deposits. I think the issue here is not utilizing broker deposits. The issue here is transparency. We have experience that shows that broker deposits can have higher liquidity risk. They can be used to fund growth that can create problems for institutions if they go overboard. And there's also a statutory requirement that if a bank falls below a well-capitalized level, they can no longer take broker deposits. And if the bank is heavily reliant on them, that can cause some disruption to the institution. Our intention here is not to limit liquidity, but to have a clearer line of sight into the sources of liquidity and the risks associated.
My time is up. I yield back.
The gentleman's time has expired. With that, the gentlewoman from Texas, Ms. Garcia, is now recognized for 5 minutes.
Thank you, Mr. Chairman. And first to all the witnesses, thank you for your service. I think it's important that we note that with the change of any administration comes changes, and we'll have to work through those. But please know that we certainly have noticed the mark that you have made and the direction that you've taken the agencies, and we thank you. As all of you know, staff diversity and regulatory agencies, like the ones that you represent, continue to be overwhelmingly white and male. I have the percentages of employees of color and female employees from each agency in front of me right now. It is disappointing. Could each of our witnesses in a yes or no answer, we'll start with you, Mr. Barr, and work this way, tell me if you're satisfied with your agency's current level of diversity?
I think there's always more work to do.
Well, after I saw your numbers, I agree with you, there is. Mr. Gruenberg?
No, Congresswoman.
Yes.
Mr. Harper, you are? Well, that's surprising because you actually have the least number of percentage of employees of color and one of the lowest ones of female employees.
We've actually, just yesterday, I was meeting with our Office of Minority and Women Inclusion about the Hispanic barrier analysis that we undertook and what were the metrics were we going to measure by success. We have seen incremental growth in the last 3 years, but it's not enough.
Right. My numbers are FY23, so perhaps you'll show some significant improvement in
So when I say,
FY24.
when I say incremental growth, we are gaining more Hispanic employees than we are losing.
Well, I'm not concerned just about Hispanics, sir. I'm concerned about all diversity.
Yes, well, and certainly, certainly female. We have currently underway another barrier analysis on that. Those are important issues. We have better numbers within our management ranks on our female employees, but we still should be doing more.
All right, thank you, Mr. Sue.
Yes, we have continued work to do, for sure.
Okay. With the FDIC showing the lowest percentages in FY23, Chair Gruenberg, can you detail the efforts you're pursuing to increase diversity and foster inclusion, especially before your departure in January?
Diversity, equity, inclusion is a core priority for the FDIC. We have a
So what efforts are you making to improve your numbers?
We have a diversity strategic plan that is focused on both recruitment of employees and then retention and promotion of a diverse and inclusive workforce. It is one of the core priorities for the agency.
Thank you. All the agencies present today have started work on climate-related financial risk. According to the Dallas Federal Reserve Bank, Hurricane Barr and other storms that hit my home state of Texas impacted a quarter of businesses in the state. This led to reduced revenue and production, extended loss of power, and increased worker vacancy. Considering the recent devastation from Hurricane Barr and other disasters, Chairman Harper, do you believe climate-related financial risk is still an important priority for credit union supervision?
Yes, in fact, after Hurricane Katrina, we lost 2 credit unions due to Hurricane Katrina's effect. That demonstrates in the micro what can happen in the macro.
All right, and have you taken any additional efforts after Hurricane Barr?
We have certainly worked to, first of all, encourage our examiners to work with the institutions affected in order to delay exams, as well as to encourage them to work with their members who have been impacted by it. We also have our Urgent Needs Grants program for those low-income credit unions where they are eligible for funds to help assist them in recovery.
Are there any plans to address these risks for credit unions, especially in coastal areas like ours and the Houston area in Texas, as indicated by the NCUA's recent estimated credit union exposure to climate-related fiscal risks report?
So what that report said was essentially that 1/4 of credit unions with 1/3 of the industry's assets are located in areas of high impact anticipated. For minority depository institutions, those exposures are even higher. It's important that we work to mitigate those. And in fact, what we saw in Western North Carolina.
But the question is, do you have plans?
We have, as part of the current budget, a climate financial risk officer that we are looking to hire to focus our agency's efforts on that. In addition, we're certainly working, as the Vice Chairman said, to measure, monitor, mitigate, and give credit unions the tools they need in order to address climate-related financial risk.
Are you placing any sort of emphasis in highlighting the Gulf Coast states?
So it would be an area in which there is risk. So Gulf Coast states, but also too, quite frankly, any state where there's a risk of flooding or other natural disasters.
All right, well, thank you. I yield back, Mr. Chairman.
The gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
Thank you, Chairman. I appreciate our witnesses making your presence here today and being available for questions today. You know, not long ago, we had some small and regional banks that didn't manage interest rate risk well and had some other challenges that led to a one-year program at FDIC to prop up banks, in part due to the way that rates were either, treasuries were either held as available for sale or held to maturity. That doesn't really change, whatever designation the banks make, doesn't really change the cash flow off of the bonds that they're holding, and you know, frankly, the Federal Reserve has the same challenge. So, Mr. Barr, is the risk from that interest rate risk passed, or has it been adequately dealt with by the instruments put in place, or are there lingering risks from this dynamic?
Thank you, Congressman. Banks have taken a number of steps to reduce their interest rate exposure to better manage that risk over time, but we still do have some institutions with significant unrealized losses on their balance sheet. And when combined with other risks that can present problems for the system, when combined with, for example, concentrated commercial real estate exposure or high level of uninsured deposits. So we're watching that very carefully. We're looking for banks to manage that risk carefully, and we've seen improvements in that, but there are still risks in the system.
So in your supervision, are there any cause for alarm in that, or do you see stability, say, in the next 2 quarters?
Well, overall, as I said at the outset, the banking system is sound and resilient. There are these areas that we're paying special attention to, that we want banks to pay special attention to, and we're monitoring that very carefully.
Yep, thank you. And one of the other things that you're monitoring carefully, but you've acknowledged that you really have a big do-over, is on the Basel III endgame. And so given the size and scope of these, quote, broad and material changes, wouldn't it be more appropriate and less subject to legal challenge to withdraw the initial proposals, make the changes, and then repropose in a single unified text?
Congressman, we adhere to the Administrative Procedure Act. We did that in the initial proposal. We've done that and are ready to do that in a reproposal. But as I indicated at the outset, given I think the importance of making sure this rule is durable and is lasting in serving the American public, my view is that it's appropriate to wait until my new colleagues come in from the OCC and the FDIC. We have an opportunity to look at that together, and I get their policy input, they get my input, and we have a conversation about it.
Thank you. I'd encourage you to continue to work with Congress here, as I think the courts have made clear that when it comes to law and some of these scope changes, really the legislative body is supposed to weigh in on these matters, not just the administrative state. And I think we'll see a lot of that theme from the courts, and we'll continue to see that from the next administration. So with that in mind, I appreciate your acknowledgement that you're looking to work with the next FDIC chair, the next Secretary of Treasury, and whatnot. One of the areas where the Administrative Procedures Act wasn't followed is with you, Mr. Gruenberg. When you look at information on deposits in the recent broker deposit proposal, something that should have occurred before the proposal was to follow the Administrative Procedure Act. Do you agree that your rulemaking has put the regulatory cart before the data horse?
Respectfully, Congressman, I think we've proceeded appropriately on 2 paths here that are really quite important.
So just succinctly, could you tell me from, 2020 final rule was done, and then you come in and suddenly there's a need to change it. What problem are you purporting to correct?
Transparency in regard to bank reliance on broker deposits, which 2 FDIC studies have found have a correlation with bank failures.
What studies, what recent data shows it? Because they did follow the Administrative Procedures Act and did present their data, and they went through a long, structured rulemaking process that you haven't followed. So where's the data?
Yeah, well, we issued a notice of proposed rulemaking. In the preamble to that, we identify the 2 studies done by the FDIC in 2011 and 2019.
Thank you. And the last comment I'd have, because my time's expiring, is I just encourage all of you to cease work on central bank digital currency. The Trump administration's been clear they will not support one, and the FDIC continues to hire people. It's clearly the will of the House. We passed it last May to end central bank digital currency. We don't want you to design it, develop it, or build it, and there is no legal authority to establish it. With that, I yield back.
Gentleman yields back. We'll now recognize the gentleman from North Carolina, my friend, Mr. Nickel, for 5 minutes.
Thank you, Mr. Chairman. Thank you to our witnesses. First question for Vice Chair Barr. The Federal Reserve's independence is critical to keeping our economy strong and stable for working families and businesses alike. It ensures that important policy decisions impacting America's monthly budgets are based on facts and data, not short-term political goals. President-elect Trump's past attacks on the Fed, calling its officials, quote-unquote, boneheads and even the enemy, are deeply alarming. His repeated promises to force the Fed to make policy decisions show a dangerous disregard for the Fed's role as an impartial guardian of monetary policy. If Trump tries to fire Chair Powell or undermines his authority, it could send shockwaves through our economy, impacting prices at the gas pump and the grocery store. Undermining the Fed's independence would threaten economic stability, risk higher inflation, and ultimately hurt working families and businesses across the country. Vice Chair Barr, do you agree?
Congressman, I think the Federal Reserve's independence is absolutely essential for serving the American public well, together with the oversight of this body and the transparency that we provide.
Can you explain why the Fed's independence is so important for our country?
It's really important that we make decisions independent of any political party or of any administration. The only thing that we want to be focused on, that the American people want us to focus on, is what's the right way of making monetary policy or bank regulation or payments oversight that serves the American people. Those jobs are hard enough, just focused on the economic analytics, and so we really have to stick to our knitting and be independent of any of the political whims in any direction.
Can you talk a little bit about the risks that could arise if a sitting president directly interfered with monetary policy decisions or pressured the Fed to adopt politically motivated policies such as premature interest rate cuts?
Well, it's incumbent on us to make sure that we act independently, and I'm 100% committed to doing that. As I said, if we act independently, if we make our judgments based on the economic facts, that's the best way to assure that we meet our congressional mandate for price stability and maximum employment, and that's what we're focused on.
As Vice Chair of the Fed, can you explain a little bit about the safeguards that currently exist to protect the Fed from political interference?
Well, there are quite a number of safeguards. We are structured as an independent body. We have protection by having fixed terms of office, both for board members and for the chair and the vice chair and the vice chair for supervision. We have a number of protections for employees with respect to the rules that govern their employment. And fundamentally, it requires all of us to have that as our key goal, that we are going to only focus on the economic facts and nothing else, and I'm committed to doing that.
Do you feel those protections are going to be sufficient to withstand potential challenges from the next administration?
I can't speak to this administration or that administration. I can say that for its existence, Federal Reserve has been around a long time. It's a strong institution. It has independence. It has accountability. It has transparency. And those values have served the American public very well, and I expect them to persist into the future.
Thanks so much. I want to talk just for a quick minute here on Basel. I'm concerned about the impact the Basel III endgame could have on those who need access to credit the most. While I'm glad you're open to changes, I think it's crucial that we get this right. A recent analysis shows your proposed revisions address less than a quarter of the issues raised in public comments. This proposal could significantly impact our capital markets, driving up costs for working families, limiting small business growth, and hurting pension funds. At a time when Americans are already grappling with high costs and with inflation likely to rise under a Trump presidency, these challenges will hit them even harder. We need to ensure that any final rule strikes the right balance, safeguarding financial stability while preserving access to affordable credit for working families. I hope you'll take those comments into consideration as you continue to adjust policy, but thank you for your answers.
Thank you.
Then I yield back.
Gentleman yields back. I know we're pushing on time, but if we can just give my colleague and friend, Mr. Rose, an additional 2 minutes here. But the gentleman from Tennessee will be recognized for 5 minutes for the last questions of the day. Then we'll recess, and then we'll take photos.
Thank you, Chairman McHenry, and thank you, Ranking Member Waters, for holding this hearing, and thank you to our witnesses for taking time to be with us. Chair Gruenberg, your official resignation and retirement announcement was welcome, even though it was far too late, in my view. Since you were last in front of us, the Financial Services Committee has uncovered even more about your unacceptable behavior, and I am not surprised, sadly. We've been watching you push the Biden-Harris administration's agenda, and we'll continue to watch your every move over the next 60 days you have left at the agency. I'm disappointed that you didn't make the right move and exit at the appropriate time. On page 6 of our committee staff report, you are cited as saying that given the close proximity of the two hearing dates, this one and the one upcoming, I am committed to making myself available to the full committee hearing in November. And I was heartened, I guess, encouraged earlier by your, I think, commitment that you're going to come to the later hearing. There certainly was a lot to cover today, and I really hope that you understand that FDIC's fundamental need for workplace culture transformation warrants its own hearing. I think you understand that. Is that correct?
As I've indicated earlier, I've agreed to take part in a transcribed interview.
Thank you. Chair Gruenberg, I fear that your conduct and leadership has forced talent to shy away from the toxic environment that is at FDIC. According to the FDIC website, there are at least 4 people in acting positions, and we hear there are more retirements and vacancies in the works. Chair Gruenberg, do you accept that the soon-to-be and current vacancies at the senior level may be directly because of your leadership and the cloud over that leadership?
Candidly, Congressman, I don't think so. We've had people at the FDIC tend to stick around for a long time. We've had an overhang of people who are approaching at or past retirement age. So the issue of retirements by long-serving employees is one that we've anticipated for a while and view as a key challenge over the next few years.
Well, I appreciate that observation, but I personally, and I think others, feel that the question and the cloud around your leadership has contributed to unsettling situation at FDIC at a time when we don't need that. And while your retirement may have prevented President-elect Trump from being able to fire you, it certainly does not mean that you have been exonerated for your actions, in my view. Last month, the Consumer Financial Protection Bureau finalized the long-awaited rule that enshrines the concept that consumers own their financial data, otherwise known as 1033 Open Banking Rule. To ensure that this rule is effectively implemented, there must be clarity as to when a bank can deny access to fintechs from accessing a consumer's data. I worry that without additional clarity, there will be confusion in the marketplace that could stifle innovation and competition. Can the prudential bank regulators collaborate with the CFPB to provide additional risk management guidance for open banking? And I want each of you to address that. So I'll start with you, Chair Gruenberg. Can the prudential regulators affirmatively take steps to provide that guidance so that we augment what the rule says?
Yes, Congressman, and we have been engaging, I think all of the agencies have been engaging with the CFPB in regard to that issue.
And Chairman Harper?
So certainly, I agree with you on the need for privacy protections, and we do have an Office of Financial Innovation that's been engaged on this issue. One last thing, though. We don't have the ability to oversee third-party vendors, and so that's a blind spot for us in this potential movement forward.
Chairman Hsu?
There has been a lot of engagement to date on this issue. I anticipate there will be continued engagement.
All right. And then finally, Vice Chair Barr.
Yes, I think it makes sense for us to work together on that. I'm happy to do it.
Thank you. That's encouraging to hear. When I talk with the bankers in Tennessee, I'm hearing great frustration about the growing problem of check fraud and the lack of action from the Federal Reserve to address the problem. Vice Chair Barr, has there been any discussion at the Federal Reserve regarding amending Regulation CC to clarify the difference between altered and counterfeit checks?
Yes, Congressman, we're looking at that question among a whole set of other issues around fraud. I do think it's an area that we need to make a lot of progress on, working with the banking sector and other parts of the private sector.
Thank you. I hope that all the agencies here today will take check fraud seriously. Our nation's community banks are struggling as it is with this issue, and it's imperative that we deliver solutions. Thank you, Mr. Chairman. I yield back.
Gentleman yields back. I want to thank the panel for your attendance. Thank you for your testimony. Thank you for your service in our federal government. And this hearing, without objection, all members will have 5 legislative days within which to submit additional written questions to the witnesses to the chair. The questions will be forwarded to the witnesses for response. I ask that witnesses respond as soon as possible, but no later than December 15th, 2024. And with that, this hearing is adjourned. Members will be advised that once we have a massing here, we'll take a picture for the official photograph of this Congress